Rachel, good morning.
Good morning, Asit. Good to see you.
Good to see you. I feel like it's been a couple of years, probably 3 years since we have been on camera together,
I know
but
it's been a
it's
while.
it's great. Yeah, it's good. We have Fool24 to jump into stuff like this. It is I know on the East Coast it's 12:14, so we're gonna have maybe 3/4 of an hour together, but I'm looking forward to this. And we have a theme that you suggested, which I really like. So what is our theme today? And I've got some questions for you. Jump right in. Let's do this.
Let's do it. Yeah, we're talking about buying stocks on the dip today, which seems like a very appropriate topic given the volatility we've been seeing in the markets lately. We've been seeing volatility across various sectors, obviously the major indices. And in the midst of earnings season, we've been really, I think, seeing this pattern where great companies are reporting solid earnings. Maybe there's a metric or two that investors, didn't like, and the stock will be rattled in response. And there's the inverse of that, where there will be a company where perhaps some of the fundamentals are shaky, but it's still a lot better than what analysts have been projecting, and the stock soars. So I think more than ever right now, it's really important to be looking at why are some of the stocks we follow or look at or own making the types of movements that they are, and when does a stock being beaten down present perhaps an opportunity, or a situation where it's better to wait and watch. So these are a lot of things that I'm thinking about right now.
This gets to the heart of my first question for you. And folks, please put in your questions. If you've got questions about how you should be thinking about markets in general, let us know. If you've got specific questions, we'll try to get to them, of course. So going back to this idea, Rachel, what does it really mean to buy on the dip? When we say this, is there like an accepted or agreed upon definition of buying on the dip that you've ever seen? Just
I,
out of
I mean,
curiosity.
in my experience, I think it's kind of a personalized thing, right? And when I talk about buying on the dip, I don't necessarily mean, oh, a stock that's been, trading down for a couple days due to some kind of reaction regarding news, or perhaps, there's something happening in the world and that drags the broader industry down. For me, I really think about companies that over a period of weeks or months have been seeing somewhat of a downward trend due to various factors, and then looking at that to see, okay, well, what is the reasoning here? And is this a quality business? Because obviously, share price doesn't tell you a whole lot about the actual business, right? I mean, it tells you what the market values a stock at that given point in time. And sometimes the market may be undervaluing a fantastic stock opportunity. And then sometimes a stock might be beaten down for a very good reason. And it's not, a moment in which it's time to go all in and rush in, with investing capital. So I think one of the most important things that I think about is, okay, maybe there's a stock I own or a stock I watch, and I'm seeing shares been beaten down in recent weeks or even months. Where are the fundamentals of the business, right? Is this still a company with a really solid business model, strong earnings, positive growth prospects over the long term? What are some of the broader industry trends that might speak to some of the movement we're seeing in that stock, but also would speak to the potential for the business and its growth opportunity moving forward, whether or not the company is well positioned for future success? And then really digging into the company's financial health, looking into their balance sheet, income statement, cash flow statement. I mean, these are all those things that maybe sound very technical and boring, but it's so important to look at and to understand the business you're going to buy, investing not in share prices, but in businesses. And inevitably, great businesses, over the long run, share prices follow. That's kind of what I think about, especially, right now as we're seeing so much volatility in the markets.
Well, that's a very convincing answer. And this brings to mind something as I was listening to you. That's sort of a phenomenon, and that phenomenon is, yes, we've been doing Fool24 maybe just for a few weeks or months, but we have a lot of time under our belts as a group of taking questions for long periods of time. This was during the pandemic when we first launched Fool Live.
Right.
So we've got some history here. Can anyone who's listening today guess when we get the most questions about buying stocks on the dip? Yes, during earnings season.
Yes.
Rachel just told us that may not really be buying on the dip. That might just be buying after an earnings result.
A temporary dip, yeah.
We don't, and we get so few questions about buying on the upswing during earnings season.
That is true.
This stock went up 20% after earnings. What should I do? I own the stock. It's up 20%. Should I buy it? Should I buy more? But we get a lot of questions if a stock goes down 20% after earnings. Maybe what you're describing is more like buying on the droop. Something is just like sliding down over an extended period of time. I mean, we like to think in terms of the long term, don't we?
Right.
So it makes sense that buying on the dip isn't really about trying to take action and to solve a problem that may be out of your control right after an earnings report. It could be if you know a business intimately and you have high conviction. Buying on any kind of downtrend, though, I think is more a function of study and conviction than it is in some type of action that makes you feel better, gives you some relief. So I like the way you put this up. Go ahead.
Yeah. The emotional piece can be tough sometimes, and I think that it's important to kind of moderate that piece when it comes to investing in stocks on the dip, because it can be very tempting to see maybe a stock that's trading down and automatically think, oh well, maybe here's an opportunity. But it's so important to dig deeper beyond what's happening there. And there's examples, and I can give an example of companies that
Sure.
I watch for a much longer period that have been beaten down. One example of a company I absolutely love is Airbnb. Over the last year, that stock's down almost 20%. It's still down pretty notably from a few years ago. This is a company that has continued to report just really, really stellar financial results from, a free cash flow perspective, from a GAAP profitability perspective. They have been really doing, I think, a great job of refining their core platform. They've been removing what they deem to be, low quality listings to really, I think, increase their competitiveness in what is a very fragmented market, but where they have a lot of, a broad footprint and an opportunity for growth moving forward. And honestly, like every time that they report their financials, I'm continually impressed. And it's also been really exciting to see that they operate obviously all over the world. North America is a very saturated market for them. And something that's really stuck out to me from some of their recent financial reports is the way in which they are seeing the fastest growth in some of these more emerging markets like Latin America, in different parts of Asia. They highlighted in their recent earnings report how Japan is one area that was incredibly underpenetrated for them within the Asian market, and how they took a series of steps, including very localized marketing campaigns, a very, very specific approach to grow their business there, and how successful that was. And it's one of those businesses where not only do I think that they're kind of in the very early stages of where their growth story could be, but I think that they're just a really stellar business from a financial perspective, especially looking at other companies within the travel sector. Now, if I had to guess, one of the probably biggest reasons why the stock has just not performed that well over the last years, I just think there's been a lot of fear and uncertainty about how consumer spending is going to impact travel, and we've seen a lot of resilience with Airbnb's financials. If the macro environment was to take a more dire turn, I think that's something that could be impacted in the short term. And when I say short term, you're thinking of, okay, a minimum investment of 3 to 5 years. Even if it's a bumpy period of a year or more, it's still relatively short term within that time span. I think that they're setting themselves up for really, a really solid financial foundation, even if things were to, take a shift in a more near-term period of time. So that's one example of a company that's been trading down over a long period of time. They've had, the moments where, shares go up and all of that, but broadly speaking, the stock has not performed super well, even as the business has done, I think, in my opinion, pretty fantastic.
I think those can be opportunities to really build a lower cost basis in a company if you're a fan of dollar cost averaging.
Yeah.
I think, Airbnb is so interesting because you have a company that thought of itself as a platform business. And at base, that's what it is. It's a technical platform.
Yeah.
And so much energy has been put in the first stage of their growth, just getting exposure to different markets. Second phase of the growth is making a platform that can be continually upgraded and serves both sides really well. So the people who are renting out their space and those of us who are coming to grab space if we're traveling. But I do like this idea of trying to understand markets better. This is sort of the Netflix approach. I mean, Netflix started out as a company which was making content in America when they went into the content business. And over time, they really got very, very good, both at partnering with local production companies and just learning what the tastes were of localized audiences. And I think this suits them particularly well, not just for nights, so building up their average daily rates, but also this experience as part of the business, which management wants to grow. And I will say, look, I mean, listening to one thing that's pretty clear about Airbnb is for a long time now, if you isolate a period, the share price and the free cash flow are classic Greek chiasmus, like this. Why chiasmus? Why didn't I say X? Too much caffeine because of daylight savings time. What is going on, universe? Why did you do this to me this morning? When I signed up on the spreadsheet, I didn't know this was going to happen to me. Yeah. I'm glad I made it here. In fact, we had this sort of long time. We started late, so maybe that helped a bit. Anyway, I'll try to keep the caffeine from
I'm caffeinated
making
too.
me say things. Yeah, to keep me from babbling. However, well, let's talk about one more thing, and then we've got a few questions already. Some of these, I think one at least is clearly tied to buying on a dip. And that is, Rachel, when you build conviction in a company and you see that, okay, Airbnb, it's some portion of your personal portfolio, I assume?
I currently actually, I don't currently actually.
Okay.
I'm
do a thought exercise.
To.
yeah, no, and that's fine. You described it very well, so I just assumed that you probably are a share owner, but we have to cover so many companies. So
I keep talking about it. That's my problem.
Same.
I've got all the time.
Oh my gosh, during earnings season and now with Fool24, different things. I have a list of companies that you probably think I own, but I can't buy because of trading restrictions.
This is the problem.
But we'll just use this. Yeah, we'll just use this as like sort of an example. Suppose you did own it, or we both bought into companies over time that the market doesn't like. At what point do you reach sort of a saturation level? You've been dollar cost averaging into a business and the market is just taking its time to realize its merits. Where do you sort of pump the brakes on that exercise?
I mean, I think it really depends on the business, right? So I'm someone that has, I think broadly speaking, invested in a lot of companies in healthcare and tech, and an assortment of companies in other industries, but those have been two heavy areas of focus for me. And some companies are a much larger area of focus in my portfolio than others. So I'm someone that is kind of constantly evaluating my appetite for risk and where that appetite is at based on what else is happening in the market, and also just where I'm at in my own personal financial health journey, totally outside of my investment portfolio. Totally. So those are things I think about. So it really does depend. There might be a situation where I get to a point where I'm like, okay, this is a company I want to have a large position in. This represents, a single digit percentage of my portfolio, but I think it's enough given some of the other companies that I want right now. If it's a company that I have really, really high conviction in, maybe I would add to. But there's so many stocks that I have, on my watch list or that I own that I want to add to. It really does depend on the business. With one like Airbnb, that's certainly one I want to add to soon. As I mentioned, I keep talking about it every few days, so it hasn't happened, but but there's so many other businesses as well. And I think that it really does depend on the actual company, the industry, where else I want to put my capital in that point of time. And in the habit of regularly investing, I find that I don't usually get too overly concentrated too quickly. And so it gives me the opportunity to really take a more moderated approach there.
I think you hit on many points that I also sort of keep in mind. And I've done this before. I've really loved a business and I've kept adding to it. I tend to start small, very small position sizes, and build up over time. And then I reach a point to where it's becoming a position that I think you said like single digit for you, somewhere in the single digits. I only once in recent memory have consciously built up a position that's hitting like more than a couple of percentage points.
Yeah.
And I paid dearly for that. What was going on with me? Why all of a sudden did I think I had this whole game figured out and no one else in the investing community did? Why did I do that? I over-indexed on a actually very good company, solid business. But then I sort of pumped the brakes because one, when you do this kind of thing, at some point it becomes a question, as Andy Cross was saying the other day, of allocation. I like this business, but I've reached the level where it doesn't make sense to keep allocating now. I'm going to allocate into other companies. So this is something for those who do buy on the droop, as we're saying this hour. Yeah, you should maybe think about that as you build that position. Keep looking at it in terms of your portfolio. And as Rachel said, your personal finance. Personal finance should be a big part of the picture that determines how you invest, where you invest, etc. Okay, so we do have a question about buying on the dip, and this comes from Ed, I believe, at the top of the hour. Ed asks, opinion of these value stocks, but with growth potential: Trade Desk, Lockheed Martin, Lam Research, and Novo Nordisk. And so, Rachel, I'm not sure if you follow any of these. I follow 3 of them, so I can opine here. But I want to take the nature of this question first, which is, are these really value stocks? To one, you have a opinion. Go ahead.
Yeah, no, I don't follow any of
this.
these very closely except for Novo Nordisk. And I would say that's definitely been I think it used to be a more value-oriented business. I think it's become much more of a growth-oriented one since the success of its GLP-1 drugs. But go ahead and answer the question, and then I can add if I have a thought.
Yeah, that's a different filter entirely, because you looked at the business and said, well, is this a value business? Meaning thereby, is it a company that has very stable cash flows, maybe sells for a sleepy multiple, almost has annuity-like returns, which describes the Novo Nordisk of a few years ago. But we've seen this company build revenue growth in the double digits over the last few years. If you look at the compounded annual growth rate of Novo Nordisk, it's up near 20%. And they're in a lag period just now where they're building capacity, but the medium term could also be maybe not 20% growth, but could be pretty brisk. So this is a good question, and it ties into my question. What is a value stock? If a company is a growth company and has been a growth stock and has a bad quarter, does that turn it into a value play? I'm not sure it does, but I will admit that the idea of what is value is subjective, and the idea of what is a value stock is subjective. So I think Ed could come right back at me and say, well, look, yeah, it was a growth stock, but did you see that quarter? No one's buying this. In fact, I think I've seen some questions from Ed to say, look, the market is telling us they're not happy about the Trade Desk. So what's going on here? And I think we had a nice discussion about Aswath Dhamarajan's idea that I stole from him, that actually should pay attention if the market clobbers a stock after earnings. As foolish investors, we are business oriented, but you should take that bit of information and seek to understand it. What if the stock doesn't pop up after a week or two? What if it keeps sliding? What does that imply in the weeks following an earnings release? Dhamarajan says, well, you really have to assume that the market understands the business and they have legitimate concerns. And then you have to really recreate the narrative and factor that into your valuation model if you're doing some kind of DCF exercise, discounted cash flow exercise. So I will say that Ed could come right back at me and say, well, in my opinion, these are value stocks. I will say in mine, the Trade Desk is a growth story. Lam Research is a cyclical type business with a growth bent and growth opportunities in an AI forward world. I respect Rachel's opinion on this for Novo. She knows healthcare companies much better than I do. And I think she just said this is probably more of a growth profile business. Yeah, and Lockheed Martin, maybe that's a value stock. It's in an industry which seemed like it was getting momentum because the world is becoming a more difficult place. And we have seen the demand for the defense companies improve over the last couple of years. But now we have, in the U.S. government, a policy directive to maybe cut spend, which could affect defense contractors. Although I read something different every day. One is that defense could be sort of a protected area, and that makes sense. Tariffs could affect manufacturers, even defense manufacturers. So maybe out of these, if I were to look at them, I would say Lockheed Martin is one I would study to say this could be like a value type business. I would say Lam Research next on the value chain because it is subject to the cyclicality of the semiconductor industry. And even though there is a lot of focus on AI, companies that are in the manufacturing supply chain, they have to produce the machines and also the chips that service the whole span of electronics. So if consumers aren't buying as many mobile devices, laptop computers, if industries aren't ordering as many sensors, IoT sensors, that affects them and can often sort of compress their total results versus a lot of AI demand. And then I would say to me, out of this group, Trade Desk is probably the growthiest and the company which has the most potential to get back on track in terms of faster growth. Maybe Novo with all its GLP-1 opportunity is just slightly behind in my opinion. But of these, I can't really opine on like Lockheed Martin. I just don't follow it that closely. But I think the Trade Desk, Lam Research, and Novo Nordisk are all quality businesses. All are run by really great management teams. I would say all have pretty decent balance sheets. I know Novo is a little bit of debt now following the Catalent acquisition and trying to build out U.S. manufacturing capacity. But I mean, these are fine companies. Whether they're value stocks or not, we'll find out in the next few quarters. We might be back here in a few months, Rachel, and I will have my hat in my hand saying, you know what, I didn't get it then, but the Trade Desk turns out it's a value business, a value stock for now. Thoughts? We can move on to another question.
Yeah, well, there's a couple questions I want to hit, but I will
Sure,
add a couple thoughts on Novo Nordisk because that is one I follow a bit more. I've said this before. I've always been a bit more intrigued by Eli Lilly's business. I think that Novo Nordisk, I've said this before, but prior to the success of their GLP-1 drugs, they were basically just known for their insulin business. That was a really slow growing business. And then they've experienced this incredible boom in growth the last few years because of their GLP-1 drugs. Now they're obviously putting that capital to really good use. As you mentioned, the Catalent acquisition, which they were and are a leading global contract development and manufacturing organization, also known as a CDMO. And essentially what this company does is they help develop, manufacture, and supply products for pharma, biotech, consumer health industries. And so the acquisition of that company by Novo Nordisk is, I think, really key to their next stage of growth. Another thing that I think could also be a real growth catalyst for Novo Nordisk is the next generation GLP-1 drug that they're working on. It's a candidate called CagriSema, and essentially it combines the active ingredient in Wegovy Ozempic, which is called semaglutide, and it combines that active ingredient with another one called cagrilintide, which essentially mimics a key hormone in the pancreas. And this new drug candidate aims for greater weight loss achievements than Wegovy. So Wegovy mimics the action of the natural hormone GLP-1, while CagriSema, this new candidate, combines that GLP-1 action with the effect of another major element within the pancreas. So studies have shown that Wegovy can lead to weight loss, with some trials showing up to 15%. CagriSema showed up to about 23% weight loss in 68 weeks, which was notable, although slightly below the 25% weight loss mark that management had been targeting. So this is a key part of their pipeline to watch. We've seen, I think, a trend, especially in recent weeks in the last couple months, where GLP-1 stocks have really been beaten down a bit. There's obviously a lot of competition in this space. There's been a lot of news about how, the U.S. government going into drug price negotiations could impact the space. It can be a volatile area to invest in, which is again why for me I've been more interested in also a really established pharma company like Eli Lilly that has a much broader and portfolio of blockbusters than a very established company like Novo Nordisk did, but they didn't really have as much of a fast growing business. So those are some things to think about, but they're both solid businesses, I think, to consider. One question I wanted to hit actually was also from Ed. Ed was asking about ELF. ELF moved up 10% this past Friday. Was it beat up so much that investors decided it was too good of a bargain to pass up, even though tariffs loom? This was interesting. I was checking to see, was there some, major news catalyst that would have moved the stock upward? I've said before, I love this business. I think that there's a lot of potential there, and something, it's worth noting. Speaking of beaten down stocks, the shares of ELF are still down about 60% over the last year. So that was a nice little bump the other day, but the stock is pretty down significantly from all-time highs. The biggest bit of news that I could find that maybe injected some enthusiasm into the stock was there was an announcement from ELF that they were launching a multi-year sponsorship with the National Women's Soccer League, which I thought was really interesting. ELF is going to be the official makeup and skincare partner of the National Women's Soccer League, and they are also the NWSL's first ever beauty sponsor. So kind of some exciting news there. I'm not sure if that would have necessarily been enough to move the stock up 10%, but that was, one of the biggest things they'd announced. They also announced that they are going to be partnering with Amanda Niken, who is one of the 6 astronauts that's been selected for the first all-female space flight with Blue Origin that's upcoming. So those are the 2 biggest news pieces with this company. But, stepping back a bit, obviously this is a stock that's been really beaten down. The impact of tariffs, this is something I've said in recent shows, but I think it's important to take a bit of a cautious, moderate approach when looking at how tariffs could impact businesses. We've seen a really, I think, unprecedented dynamic in terms of the way in which tariffs have been announced. Very quickly, sometimes that news changes. There are exemptions that are announced. Now, in the case of China, where recently an added 10% tariff was imposed in addition to existing, duties for specific shipments over a certain threshold. It's worth noting ELF does manufacture and source for most of their suppliers are currently in China. They also have, sourcing in other parts of Asia, but that's a huge area of focus for them. I think that this is a dynamic that will not just impact ELF, but continue to impact any other company across different industries that has huge exposure to sourcing some or all of their core underlying product from China. I think the bigger companies that are very capital efficient will be able to pivot and, move beyond the impact of that faster. I think that ELF is still in a solid position. I think that this is one where it's reasonable to expect that there will be an impact from tariffs, but it's very unclear to what extent yet. They might be able to, for example, shift to start working with some suppliers within the region. They might already have, connections and networks within that area. I think that this is more of a wait and see thing. I certainly wouldn't, buy on the dip specifically related to tariff news. For me, this is a company I have a lot of conviction in long term, and why I think that it could be a solid business to buy while shares are being beaten down. This is a company that continues to increase their market share. They just delivered their 24th consecutive quarter of net sales growth. They are very profitable. They continue to improve their GAAP net income as well as their cash flow position. They had some softer than expected sales trends in January. They slightly decreased their guidance, but they're still expecting up to 28% year-over-year sales growth in their fiscal 2025. I really like this business for the long term. I think anyone evaluating this, it's important to incorporate the impact of geopolitical changes, the impact of things like tariffs into one's risk analysis. But I wouldn't keep me away from this one.
Mm. Yeah, I think ELF is such a fun company to study. It's a very dynamic business. The question mark that I have on it, and it's not germane only to ELF, it's for a lot of companies of its size. So we had really one big, actually a couple of big disruptions in supply chains since the pandemic. So large and medium-sized companies, I think they did take that opportunity to diversify where product was coming from. And in the previous Trump administration, because of geopolitical risk, we saw companies start to reorient into South Asia. And I believe ELF does have some South Asian manufacturing, maybe Vietnam. I'm trying to remember where it is. So it's not like 100% China, but
No.
it's concentrated there. You could probably pull it off the top of your head quicker than I could, Rachel. But
Yeah,
I
yeah,
go
they
ahead.
have a lot of. I'll just say they have a huge portion of their third party suppliers are in China, but it is worth noting that in their fiscal 2024, about 30% of the mica that's used in their elf beauty products was actually sourced from India. The
Mhm.
remaining 70% was sourced from other countries, primarily China. But you're right in the sense that they have diversified, and I do think that provides them an opportunity to pivot as need be. They have
Yeah.
established relationships in these other regions.
Yeah. So I think get that transition started so you can reduce the concentration on the books is positive. And I would like to see them be a little bit less profitable. And what I mean by this is one of those companies. Another one that comes to mind is um, the translation company, the app, which is um,
Is it Duolingo? No.
yeah, Duolingo. It's Duolingo, right?
Oh,
Again, daylight savings time. So Duolingo also is a company that's very savvy at marketing and utilizing sort of this very strong propensity to know how to hit social media channels, and from that just getting a lot of mileage. So think very little spend but smart spend and a lot of yield. I think Elf is great at that. But things that will grow the unaided brand awareness, so partnerships like it just announced, being a little bit more visible on a sponsorship level. Company like Wingstop is also in this boat. I think those are net
mm,
positive for businesses like this. There's a point where you want to have a little bit less variability in future cash flows if that marketing engine, which is really predicated on being able to reach people from your smarts rather than your spend, if that hits a bad quarter or two. And we saw the management team talk about distractions like the fires in California, which really pulled the focus away from social media. And this was one of the reasons that was posited that the results weren't as great. So I wouldn't mind seeing them. I think maybe some other investors, we don't know, like 10% moving upward on this news, potentially, if that's really what it's from. Maybe other investors also have this hunger, like we it's okay, spend the money. You're a growth company. We understand you can run this business profitably, and we like that. And in fact, it makes you maybe more eager to invest in a company that's adaptable vis-a-vis its marketing strategy. But anyway, I keep forgetting that we started so past the hour, so I'm going to keep my answers a little short. I keep thinking we've got another half hour to go, but let me just ask quickly for your thoughts. I'll give my thoughts first, and then ask you. This is a general question from Anthony Bacalo. I hope I pronounced
mm.
that correctly. Or that might be Bacayo. It's hard to tell. Um, Hi, what do you look for in the market to determine if the market is recovering from a minor pullback or if you might need to wait a bit before going back in? And I'll just say, Anthony, in my experience, I'm really not great at timing the market at all. So I tend to just buy regularly. I love dollar cost averaging, and I always also keep a cash component. So if I do see that despite my best predictive capability, the market keeps going down, at some point I have a gut sense that it's time to put some of that cash to work as well. So focusing on businesses, as Rachel was saying at the beginning of the 3/4 hour that we have, and just trying to buy regularly and where the business is throwing you a signal rather than the stock or the markets. Maybe the best strategy for those who will be holding stocks for a 5+ year period.
Yeah, I think that that's definitely my approach as well. It's one of those things where I wish that I had, a crystal ball to determine what the market would do next. That would certainly make investing so much easier. But the fact is, sometimes we can see a situation where, last week the Nasdaq kind of briefly dipped into correction territory. We don't know whether that signals the beginning of more volatility, whether it could signal more corrective territory ahead. It's very difficult to know. And the thing is, timing the market, it's not a strategy that works well for long-term investors. When you're investing in businesses for years and sometimes decades at a time, uh, corrections, bear markets, bull markets, everything in between are normal. They're part of that life cycle of the market, and they are really unavoidable if you're going to stay invested in the market, and that can be really difficult in the moment. But it can also provide a little bit of added comfort in the sense that there's really nothing new under the sun when it comes to the stock market. These periods are not fun to go through as long-term investors, but they are normal, and if anything, that they are a healthy part of the functioning of the market. And there's always opportunities in both up and down market periods. So I don't so much, look to try to, divine what the market will do next, because I'm not smart enough to know that. I don't think that's something that I could predict with any accuracy. What I do is I evaluate my portfolio. I see what's happening with it, and I think to myself, okay, is this an opportunity where there's stocks that I have on my watch list or stocks that I own that maybe I want to add to or build a position in? Is this a time where, maybe I want to take a step back, sit on the sidelines a little bit? It's not fitting with where I'm at right now in my own risk tolerance and my own financial health to want to necessarily dip in more than I already have in my portfolio. And that's something that I reevaluate, regularly. And I think that habit of regular investing is really key. And it also takes the guesswork out. And there's been a lot of data that has shown that honestly, that there are really a few days of the year which are the best days to invest in which the most returns for investors' portfolios are gained. But the thing is, we don't know when those days are. So I would much rather stay invested, keep investing, and benefit from those days. And for that, I'll take some bad days along the way. To borrow a quote from Danny Venna, he says it's part of the price of admission, and I agree there.
Yeah, very much so. And there are some years where only 5 to 7 days make up the bulk of the market's gains. Okay, so Mukund has this question. What is your opinion on FXI, the iShares China Large Cap ETF? China seems to be much more ahead of the US in EVs and other areas, AI and GPT models. So I think that's the first part of this, the idea of investing in a country through like a well-capitalized fund from a reputable fund provider. It's not bad at all. I do that myself. So I haven't looked at FXI, but I know it's a iShares product. So you'll probably get reasonable liquidity and a reasonably low fee out of that. I would look at the holdings of that. This is the first thing I do to see where the fund invests. And I would say on your larger point, in some areas, sure, I think China's taken a manufacturing lead. We have to understand that almost everything we see in terms of an economic output in China is very policy driven. The government incentivizes certain industries. It disincentivizes other industries from time to time. It disincentivized the big consumer tech companies a few years ago, especially those that were in the gaming sector. And we also have to recognize that China has a problem in reorienting its economy from one that has traditionally benefited from the growing prices of real estate to one that is trying to be more an export type economy. And so this is problematic, even though China is producing amazing vehicles, electric vehicles at very low cost. We have to remember part of that is subsidized by the government. And there is a question of flooding the markets with supply. The next place that China is trying to do this is to take the technology it learned in the EV space and apply some of that to robotics, that manufacturing technology. So I would be careful just from seeing that China has definitely, a lead in the EV market to extrapolating that into terms that they can really transition the economy to where the companies that are producing these will be able to do it profitably. There are some like BYD that, they are interesting to study as investments because they are leading and making profits, but not every company in China that hits an ETF like this has shown the ability over long periods of time to sustain profitability. So we have to keep that in mind. And I would say that no, China isn't actually ahead in AI and GPT models. I actually love the DeepSeek model. I am very interested in how DeepSeek built their model, and their paper, if you have time, is very fascinating. And I think that's just a great wake-up call, not just to the US or to China, but just for people who are building models globally, that you don't have to assume that it takes tens and tens of millions of dollars to build a really good foundational type model. It can be done with less. Now, does it still cost in the millions? Yeah, but we can put that constraint here in the US on what is right now still a higher level, a bigger ecosystem, and I think a much deeper ecosystem for AI. We can also use many of the same methods and start with the proposition that if you build a model, it's not just about buying more GPUs to make it brute force more powerful, but there are ways you can challenge assumptions that models have been built on for the last few years, ever since the transformer model of neural networks really started to become very popular. So I would say, it may seem like that, but China is actually still behind on AI, and they're constrained on their capacity, as we all know, to get the chips, which will be very crucial going forward. So I would say with any country, not just China. I mean, I sometimes talk about India. I talk about Germany, even the UK as being interesting markets, but you got to take it all into context. And like you would do anything else, don't over-index into any one ETF. And I know Mukund is not, I'm guessing from other questions I've seen, he's not someone to just, bet the farm on a single country ETF. But a fascinating question to consider for many reasons. Rachel, what have you got next?
Yeah, I wanted to answer this question that came in from RH about Eli Lilly. It was saying, I sold a few shares of Eli Lilly this week because it had rocketed up too fast, then it went down. What are your thoughts of Eli Lilly's future? I am a shareholder of this company. As I mentioned, I'm also really, really like this business. The stock itself is trading up about 18% over the last year. This is also a company that I have really favored as an income investor. Their yield is a bit on the low end, but they have paid a dividend in some form since like 1885. They have been a really fantastic company for income investors over the years. In terms of the company's growth prospects, it's worth noting this was a very, very established. They've been around for since the 19th century. Very established company with a long history of blockbuster drugs, well before the GLP-1 craze hit their balance sheet and the impact of that. And then their drugs like Mounjaro became one of their top selling drugs. They, other examples of their diabetes treatment, Trulicity, that's been a long-standing blockbuster for them. Verzenio, which is a CDK4/6 inhibitor for numerous types of metastatic cancer. Jardiance is another top-selling diabetes medication of theirs that they are known for. Moving forward, I think success in the GLP-1 space is very likely in its early innings. I think that what we're seeing is there is a lot of potential for these types of drugs to be used in a lot of different types of disease areas, not just in weight management or diabetes. And Eli Lilly is currently studying its drugs for use in numerous other potential disease areas, including patients who have weight management concerns or diabetes, but also have certain cardiovascular problems. So there's a lot of ways in which I think we're just starting to see what the potential for those drugs can be. And then, as I mentioned, they have quite a number of other top-selling blockbuster drugs in a footprint in spaces like oncology, like diabetes care that extends well outside of their GLP-1 footprint. A few other drugs that I think are notable for their growth story moving forward. One is their Alzheimer's disease treatment that was just approved last year for early onset Alzheimer's. This is something I think that's going to be a significant revenue generator for them. Another one is it's marketed as Omvo. It's a therapy for ulcerative colitis. That was more recently approved in October of 2023 for treating Crohn's disease in adults. And then it had been approved before that for ulcerative colitis. And it was the first biologic treatment in over 15 years with 2-year phase 3 efficacy data in Crohn's disease at the time that it was approved. So really, I think a landmark move for the business. There's their drug. It's called Ebglyss, and it's something they already have that is approved for numerous indications currently, those with moderate to severe eczema, but it's also being studied as a single monthly maintenance injection for patients with moderate to severe atopic dermatitis. And there were really positive results that just came out from an ongoing trial studying that potential, new indication. So there is a lot of factors for the business moving forward. I think that there is also, like I mentioned, significant pipeline progress for their existing drugs like Zepbound, which is one of the names for their GLP-1 drug. They recently had that drug also approved in the US for moderate to severe obstructive sleep apnea in adults who also have obesity. So there is so much going on with this business. These are just a few of the growth factors here. Their balance sheet is in stellar shape, both from a profitability perspective, a revenue growth perspective. Do I expect that they're like in Q4 where their GAAP profits grew 101% year over year? Do I expect that that's going to continue indefinitely for the next 10 years? You're probably going to see a slowdown at some point. The boom they've had the last couple of years will moderate at some point, but that doesn't mean the quality of the business has gone anywhere. And I think that as they continue to look into new use cases for their existing drugs, as well as develop their really stellar pipeline, I think there's a lot of room for this company to run. They have reinvented themselves through many, many different life cycles of their business. And as a shareholder, and this is a company I intend to hold for the long term, I'm excited to see where the business goes in the next 5-10 years and beyond.
Great. So Rachel, you're staying on the next hour. Is that correct?
I'm actually taking an hour break, and then I come back in an hour.
I see Tyler here. I think I've got 10 seconds to squeeze in an answer from Mark. What are your thoughts on Dell, symbol DELL? Yeah, Mark, I've avoided this company for a long time because I felt it plays in commoditized businesses, but I think it deserves a look because it's a strong player, well suited for AI infrastructure, as you probably know from asking the question. So I think it deserves a second look from many of us who just haven't been very excited about servers and helping enterprise businesses fighting with HP and other companies. So it does have a very fast growing component in AI related servers, and I think it's a quality company. Obviously, management is very seasoned, so it's one to maybe look at. I'm not a believer that AI infrastructure spending is going to disappear over the next 5 years. I think it may get adjusted around the margins, with that, we're at 1 p.m. So we will wait for our next.
I think Neil and Tyler are coming in.
Okay,
next.
There I see. Yeah, Neil. Got it. There's Neil and Tyler. Hello, guys. Happy Sunday.
Hello.
Good.
Hello.
Good afternoon.
Show.
Good evening. I've completely lost track with you guys doing the daylight savings time and us not. So whatever
Same.
time it is on the East Coast,
So where is it in everyone's time zone before we go? It's 1:01 here on the East Coast.
6 p.m.
And remind us where you
9
are
p.m.
again, Neil.
Belgium.
Okay, and then for you, Tyler?
9 p.m. in Tbilisi, Republic of Georgia.
It's
And
6
Rachel?
p.m. and it's 6 p.m. in Italy where I am.
Okay, wow.
Yeah,
All
so
right,
we have the same time. I also woke up this morning. I'm like, wait a second. Should I be on at 6 or at 7? I'm like, did we change the time? I didn't know about this.
I feel your pain.
All right. Well, so great to have such an international crew before me. I actually feel very plain and domestic today. But with that, I will let you guys go. Have a great hour. Rachel, so much fun. See you soon.
See you soon.
Well, thanks to Asit, thanks to Rachel. Rachel will be joining me in the next hour. But for this hour, Neil and I will be joining you with a little bit of an Ask Us Anything. Apologize for the less structured format than we've been getting a little bit used to here. That's mostly my fault for being away for a few days. So first off, number one, welcome to everybody, either both Fool members as well as people that are tuning in via YouTube. For those of you who are coming to us through YouTube and you want to ask questions, please go to sli.do, the website, and use the promo code Fool24 to get in your questions. We have a moderated board of questions there that you can bring them in rather than using YouTube directly. It's a way of us helping moderate the conversation a little bit to make sure that we're getting everything that we want to get to. My name's Tyler. I'm with Neil. This is actually Neil's and I's first time together. Neil, I'm guessing you're mostly tech, right? Am I right in that assumption?
No, you are right. I am tech, fintech, semiconductors, and some Chinese stocks. Yeah.
So
What about you?
pretty much zero overlap in what we do, with me doing energy, industrials, materials,
But that's
kind of
good.
a little haphazard. Yeah, so lots of places to cover, although we might not share a lot of opinions on the same stocks. So as we get started here with Neil, was there any questions that you saw you wanted to hit right away, or was there maybe a news story that hit over the weekend that was really interesting to you? The floor is yours.
There was one from Matt. I don't know if it's a question or a statement from Matt 33 minutes ago about PayPal, and I feel him. Although I'm a new-ish PayPal shareholder from a year and a half ago since Alex Chris came in. So he says, when I first bought PayPal at $140 per share in 2022, I thought I was getting it on the dip, but it was actually much more of a falling knife. And I would like, because this is going to be a broader question on the topic of catching falling knives. I'd love to hear your opinion on it.
On the subject of catching falling knives,
Yeah.
I tend to cut myself an awful lot. I can draw my experience less from PayPal specifically, but I will talk about probably the time that I did this the most was during like the mid 2010s, when oil prices basically went from like over $100 a barrel to down to into the 20s. There was kind of this idea of like, it can't get worse, it can't get worse, it can't get worse, and it just continued to get worse for what was like 5 years. And between that and the stunted recovery from 2020, there was just this very long period of just equity getting wiped out in much of the oil and gas space. I think it was something like $1 trillion worth of oil and gas company equity went through bankruptcy proceedings over a 5-year period, which, it doesn't, when we talk about $1 trillion these days with, NVIDIA and things like that, having $1 trillion market caps for companies doesn't sound like much but for the industry itself, which was at the time maybe 2-3% of the entire S&P 500. This was massive amounts of wipeouts. And so I don't know. Every once in a while, I would say there's maybe one time in my life where catching a falling knife actually worked out for me. And the rest of the time, it's caused pretty lasting damage for a while. And, I sometimes over like 6 to 10 years, you might make it into a decently profitable investment. But, when you look at kind of the table, the alternatives that are available out there, sometimes catching a falling knife is, I don't know. I find more often than not, it's more or less just worth waiting for the business itself to show, structural turnarounds or, reason of promise before trying to, try to time like, when the market is going to react to what I'm seeing. I think that's been one of my biggest mistakes, is trying to be smarter than the market, sometimes being like, once the market realizes that I'm right, it'll be revalued. It's rarely worked out for me.
Okay, no, interesting. But I mean, what happens when a company itself is doing quite well, but the stock does not reflect a reality? So it's a bit of a flip here. Like, company doing well, maybe the stock just ran up too much and now it's correcting itself, but the business is still doing what it should be doing. It's just that the market either made quite positive assumptions and that's why the stock went up in a short amount of time and now we're getting back to normal levels. Would you say that it's still in the catching falling knives category and not in a I like the value, I'm okay dollar cost averaging until a certain price?
That is a great question. When it comes to just the business fundamentals itself, and it's more just an issue of valuation, I don't know if I'm not one that's too keen on dollar cost averaging personally. I'm very much I'll just sit on my position and wait. And if in the universe of companies that I'm looking at, it becomes attractive again, I will make that purchase. Depending on valuation, of course, because valuation is a tricky thing, right? So let's say, for example, I'm let me, you know what? I'm going to actually look up PayPal's like price to earnings ratio or something like that, just to kind of keep
It's
it on
low.
topic with PayPal. Well, it's low today, but you know, what was it like, you know, 3 or 4 years ago or something like that?
Yeah, you're going to get a big difference because 3-4 years pandemic, super high premium,
Yeah.
company was growing quickly. So I think the mean is, well, I would say 1924 p or something like that, and now we're well below that, if I remember correctly.
Yeah. So in July 2020, PayPal had a PE or price to earnings ratio of 112 times. So very expensive objectively, like even with the most optimistic, you know, sort of conclusions that you would have on a business, that is wildly expensive. And then around the 2021, 2022 time, you know, varying somewhere between 25 to 50 times earnings, which I may be a little bit different than most people, but I would still say that's pretty expensive, even with decent growth baked in. I think a company that can grow its earnings, you know, 10, 15% annually should be somewhere trading in the 20 to 25 times ratio. At least that's what I'm looking for personally. So when it comes to a company like PayPal today, where it's trading for 17 times earnings, it does appear to be in a much better looking position. It seems like the company is in a better place and would be something like I may be willing to look at. I have to confess, PayPal personally is not something that I know very well. So I would have to definitely go dig into it and maybe like see, you know, I know that advertising has been a big boom for them, and that's been part of the reason that we've seen this uplift. Is the advertising component of this business going to be enough of an uplift in the coming years to justify you know, a reversal and a on a profitable level that it's actually sustainable and not, you know, the cyclical nature of advertising. So, you know, this certainly, at this point, business is doing better, 17 times earnings for what is probably, I don't know, better growth. I don't know if it's spectacular growth, but yeah, I don't know if this is considered a falling knife anymore, because we've gone from 115 earnings to 17. That is a sharp thing, a sharp drop. I typically, I think like falling knife is, you know, maybe a 10, 15% drop or something like that. This has been a little bit more than that, and a definite kind of like structural change in the way that this business is being valued and viewed by the market. So, yeah, I think that's about as far as I can go with this one. It certainly looks more attractive than it did then, and you know, falling knives are always tricky.
Okay, fair enough. I mean, I only opened a position, a bigger one. I mean, I increased my position over time after the change in management, because there is a new CEO. Alex Chris came in a year and a half ago, completely new management team. And yeah, at first I was like, okay, let's wait and see if they can really turn this ship around. And it does seem like it's taking a while, but at least they're now showing us that on the profitability side of things are moving in the right direction. And that's why revenue growth, I think you can see that revenue growth, high single digits, which is of course not that attractive. I mean, I'm investing in tech, so usually you get revenue growth closer to 20, 30% if you go with the big tech companies. But I do feel, I mean, free cash flow wise, it's increasing. So that's great, because before that has been plateauing. Even though revenue grew faster than today, free cash flow did not, which isn't great. But it's definitely a long-term story. It's not something that, oh, next quarter we're going to see suddenly revenue reaccelerate above double digits and stuff like that. But at the same time, they are growing in a profitable way, which I think is much better than growing at all costs. So yeah, lower PE makes sense. I mean, risk reward wise makes sense today compared to what it was a couple of years ago.
Yeah. It looks like a lot of the questions so far have come in our tech. So I'm going to kind of dig into the leftovers of some previous questions that we've had. So again, people who are tuning into Fool.com, either through membership or through YouTube, please go to slido.sli.do. Get your questions in by adding the promo code Fool24, and we will do our best to try to answer your questions. I'm going to take this question from about 2 days ago, as we wait for other questions to come in, so we can kind of fill the backlog, and hopefully the person who asked this question a couple days ago will be able to get their question in, or be able to get this response. But Heidi/R asked 2 days ago, I would like to know what's the outlook for ticker FSLR, which is for solar. And thank you. So thanks for the politeness. So this is a business that I've owned for a long time, personally, and one that I've had very mixed feelings for it. I always think it's an incredibly well-run company. I think it's a little bit misunderstood, in the sense of it is solar, it's renewable energy. So I think a lot of people look at, you hear renewable energy, you see the installation trends, you see all of the production growth that we're seeing in solar as kind of this almost exponential growth. And the assumption is like all the companies in this industry must be growing at exponential rates, when the solar panel manufacturing industry has been a very cyclical one. And at the same time, a little bit of I don't want to say a commodity, race to the bottom. It certainly has been highly commoditized over the years. I think First Solar has done probably one of the better jobs in this industry in terms of margin preservation, in large part because they do use a very unique panel relative to anybody else. They have a couple different ones. It's called a thin film technology versus the typical polysilicon wafer that is more or less a semiconductor. That's what most solar panels are. They use a thin film, which uses both cadmium telluride and copper rhenium kind of thin film production. In the lab, it doesn't look as good compared to some of the things that we're seeing in polysilicon production these days. But actually, out in the field, they tend to be they're more durable. They're testing efficiencies in the lab versus what's actually on the ground is a little bit better. So it's been a good business, and First Solar sells exclusively to utility companies, which has been a much more stable component of this industry relative to, like, if you're a manufacturer that sells to the residential industry, which has been absolutely whipsawed by interest rates, right? First Solar itself, I think it's been in a really good position. I know there's a lot of trepidation around renewable energy these days because of shifting political winds. But one of the nice things about First Solar specifically is they have a very, very large backlog of orders that should take multiple years for them to actually fulfill. So with that much kind of time to work out, new orders, things like that, and demand growth is going to be an important component of electricity in general. I think that First Solar actually looks quite good over the next few years at least. Certainly, it's not going to. I don't know if it's going to blow the doors off, but it's well positioned for the next couple of years to at least ride out any uncertainty in the market when it comes to ordering solar panels and things like that. And it has some other, I would call it, inherent advantages. Beyond that, they're working on a new type of solar panel that should actually be a stepwise function up in solar panel efficiency, which would be huge for them. They're looking at a new type of panel. It's basically a dual panel with their thin film attached with the word escapes me right now, but it's basically it's two types of films. You would have your thin film copper rhenium on top of this other one, which is crystalline structure. It basically doubles the efficiency of current panels because it can absorb more of the whole light spectrum that's hitting it at any given moment. It would be, if commercialized, would be a game changer, I think, actually, in solar, if fully commercialized. They started talking about the development and deployment of that in their most recent investor presentation. So I think there's a lot going on there that's pretty interesting. And, all things considered, this is a business that has been run very conservatively from a management's perspective, always keeps a net cash position, has been very, very conservative when building out new production because they don't want to have a whole bunch of idle production for many years because of the cyclicality of the industry. So from a business perspective, I think this has been one of the better investments. And then from a timing perspective, this has been stock price wise, this has been quite a decline for the company. And, the next couple of years might look a little weird because of, market sentiment, because of political climate, things like that. But all in all, I would say this is one of, I like to think of investing in like Windows, buying Windows or things like that. And I think the valuation based on their current prospects, it looks like a decent opening of the buying window for a company like First Solar.
No, I agree. I actually did take a look at First Solar not so long ago, and now you touched on the difference between a First Solar and an Enphase, for example. Enphase, of course, because of high interest rates. I mean, if you look at their revenue, for example, completely obliterated in the last couple of quarters. A First Solar, not so much, right? If you look at solar module gross profits or even revenues, still doing quite well. Margins are still doing well. So all in all, I mean, right now what we're getting is a company that is still executing quite okay, if not better than okay. Some headwinds, macro headwinds for sure, but valuation-wise, I think, what is it, under a PE under 10 right now? 4 PE or something like that, under 10 last time I checked. Still expected to grow quite quick, quite rapidly, so yeah.
Is this for first the PE? Are you looking for Solar and
First Solar, yeah.
Valuation? Yeah, it currently has a PE of 11.6.
Yeah, I mean, and they're expected to grow quite rapidly, I think, no?
Next couple of years, I think I wouldn't say rapid because it could come down to a lot of pricing. They are expecting to see panel growth, but in terms of volume production, but pricing can always be challenging, especially as we said, interest rate environments, things like that, a little bit more competitive.
Okay. Let's see.
This is interesting because you brought up Enphase, and there's another later question in the group, in the chat here from a few, actually it was 4 days ago, and it was from Vihan, and it asked specifically about solar, Enphase, First Solar versus SolarEdge Technologies, and was asking kind of the ranking of the gold, silver, bronze of these companies. So it sounds like you have Neil. It sounds like you have a question. Opinions on Enphase and First Solar. So if you had a ranking of these, where do you think you would go?
Probably at the moment, I do First Solar, Enphase, SolarEdge. Although, I mean, even with the positive reaction and positive comment that we got from SolarEdge not so long ago, I think the recent quarter, I'd still go First Solar, Enphase, and then SolarEdge. SolarEdge more focused on Europe, Enphase more residential, lots of headwinds currently with the high interest rates. First Solar, you've just explained as well, still with all the headwinds, I think they're still in a better place. Pricing wise, I think it's also more attractive. So First Solar, Enphase, SolarEdge. How about you?
Yeah, I kind of had in the same order too. And from the SolarEdge perspective, Enphase and SolarEdge don't make panels like First Solar does, just for everybody that's listening. So Enphase and SolarEdge are two companies which basically make, we'll call it like the brains of a residential solar installation. It's the thing that takes the power from the solar panel, which typically comes in direct current, DC current, converts it to alternating current. That itself is not the most special part of these components that they make. They call them optimizers or inverters or things like that, but it's also like a safety component where it if a panel is overheating or goes out, it can shut off that individual panel and let the rest of the system work, versus like the entire system shutting down with one panel going out. They have also built some smart metering into these components where they, it'll know when it's best to deliver power to the house, deliver power to, like, say, a battery system at the house, or to sell it back to the grid based on times, things like that. So smart metering is a component of this things as well. So a little bit different from the solar panel, and both of them very, very dependent on the residential area. The one thing that I will give Enphase credit for is during this recent downturn, they have been much better about managing inventory, kind of managing the downturn. Enphase themselves don't actually manufacture any of their products. It's all done by third-party manufacturing. So it's allowed them to scale up and down much easier. SolarEdge has had a lot of inventory problems over these past couple of years, couple of years. As the downturn has come, inventory's been building, they've been burning through cash, trying to like, get their finances back in the right place. I mean, they're not awful, but they're not good either. So when it comes to these three, I think for solar has the best opportunities coming forward. I think, and then of the other two, I think Enphase so far has shown that they're better managed because they can manage not just the upside, but the downside, because this has been an industry like the optimizer side of this business has been this weird, like, I don't know, defy gravity of the residential solar industry, because it's been a race to the bottom, if you will, like with this sort of stuff. Like every component in renewable energy has the pricing has dropped precipitously over the years. And this has been like the one area where like margins were preserved, revenue growth was really strong. So it was really surprised to see like how long they lasted. And then when that drop in demand actually finally came, Enphase was able to manage it better. So I kind of ranked him in that way.
Yeah, no, same thing. I think they, even with revenue decreasing, I think they still managed to generate free cash flow, which is quite good. So they'll get second place.
Yeah.
Let's see. We have it's more on the tech side, semiconductor side of things. MC asking here 17 minutes ago, could you please give me your thoughts on AMD? And then he has a very good, nice compliment for all of us here at the Fool. I've been so appreciative of Fool24. Thank you for all your expertise and time. Well, thank you for tuning in. Really appreciate that. We appreciate all of you actually tuning in, asking questions, even about companies we do not know much about, but we might do research live on the show and get educated along the line as well. So thank you all for joining. With AMD, it's quite interesting because AMD at the moment I think traded around $100. AMD a year ago traded at around $200, and sentiment is a very important thing I've noticed in the stock market, because at $200 AMD was portrayed as the next Nvidia. Now at $100, it's portrayed as more of a might be the next Intel, which is quite interesting because they beat Intel in the last couple of years. But AMD this year, 2025, is going to be quite a crucial year for the company because of the releases of the MI350, which is a competing GPU to, let's call it the NVIDIA Blackwell. It should have been released in the second half of 2025, got pushed forward to mid-2025, which is seen as something bullish. In 2026, that's when the MI400 is coming out, and that should be a competing product to the NVIDIA Rubin, which is their next generation product after Blackwell, and even after the Blackwell Ultra, which is also a product for later this year. But there are other tailwinds for AMD, which have been headwinds, which is the gaming side of things and the embedded side. First of all, the gaming will be reported in the client segment as of next quarter. So you're going to see data center client and embedded, not a data center client, gaming and embedded, in case you were wondering why things will change soon. But gaming, embedded have seen some headwinds across the board, not just for AMD, across the board, some headwinds. And once those headwinds are over, which should be the next 2 quarters or so second half of 2025, that will add to, the revenue that AMD generates, which has been basically coming down for the last couple of quarters. And $1 billion here, $1 billion there might not be that big of a deal for a company like NVIDIA, who generates $35 billion just from the data center side of things. But for AMD, it's going to be a big deal. Embedded ones, the embedded segment, I believe there was an executive that said that in 2024, they had over $14 billion in design wins. The embedded side of things is also quite profitable of a business. So AMD, although the stock is under pressure, might also be in the falling knife category because it went at 200, now at 100. But I do like the business today a lot more than I did a year ago. And that's why a month or so ago, I became a shareholder of the company, because I do like these sentiment changes. So when things go up, it's the next NVIDIA. When things go down, it's the next Intel. For me, I just look at the business. I liked what I see, the price that I paid. I liked for it, of course. It went down a little bit more, but that's fine. I'm building up my position. And I think the overall company, the overall product portfolio that AMD has today is much better than what they had a year ago. Of course, as we know, in that business, execution is key. And if you want to compete with NVIDIA, you have to execute flawlessly. So there is AMD. If you want to add something, please go ahead.
I know better than to make comments on things I don't have the slightest clue about, and semiconductors is definitely a blind spot of my my zone of comfort and coverage. So I'm gonna kind of do the Charlie Munger thing and say I have nothing to add. I wanted to, this could be a great question for both of us, since it's not even a single stock related though, but about 20 hours ago, or so yesterday, Cena NYC asked, any tools you like for keeping a watch list, one or a group that allows for storing a nice mix of qualitative and quantitative info and is searchable. So I without being a blind shill for the Motley Fool, obviously, Fool.com members get there's a lot of options, but as paid members in terms of watch lists, tools and information that is available for stock stickers, premium recommendations, things like that. So there are a lot of tools that are available for Fool.com members who are members of Stock Advisor and the other various services that are available to us. So I'm going to, without talking too much of the Motley Fool book, we'll do a couple of products outside of TMF universe for that. So for me, the biggest tool that I have been using recently in terms of watch list and as well as corporate info that allowing me to search and kind of evaluate things relatively quick is Koifin. There's tons of tools out there like this. I don't, Koifin, FinChat, Y charts. There are dozens of them out there that are available. I think it's just come down to personal preference for me in terms of I've got all these watch lists and screens already built up in this particular one, so it's one I've become fond of. It's almost more like I'm comfortable with it now, and it's my comfort blanket versus me independently evaluating them all differently and saying one is better than the other. This just happened to be the one I signed up for. But I do very much enjoy it. It's been worth the price for me, although this is kind of my job. So I'm willing to maybe pay for a little bit more than maybe the weekender who's just a viewer of this. But it's a product I really enjoy. I think the data and analytics that it has, or the 10 years of financials, even further with charting and looking up fundamental analysis and things like that, SEC disclosures, transcripts, kind of everything I want, and as well as screens and watch lists. So that was one that I would mention. Neil, what do you use for tools in terms of watch lists, looking up all your information?
Well, you just stole all my answers. It's basically the same. It's basically also the Fool, of course, Koifin, and more recently FinChat. I mean, more recently, the last couple of months. But yeah, it's great for screening watch lists, transcript search, for example, the specific terms. And of course, like you said, I mean, we do this on a day-to-day basis, so it's worth for us to pay the price to use those services. For those that will use these types of things like a Koifin or whatnot once in a while, I don't think it's worth it. Plus, I also have an Excel sheet, the old school way of doing things. Yeah, I
was also going to mention too. I mean, it's hard to go wrong with the SEC search engine Edgar. I mean, if you're looking up information, there's no better place. The SEC website for all of that is surprisingly searchable and quite functional. And anybody who is looking for information, there's no better place than the true source, which is SEC disclosures.
Yeah, no, I agree.
If you're still looking for a question, I can hit this one right now because Vihan just brought it in, and Vihan, I hope you were able to catch the questions that we that were some of the ones that you had asked previously. But since you're on right now and you're asked on thoughts on ARE, Alexandria Real Estate, can you help with valuation? Would you consider this or look elsewhere for your precious capital. So Alexandria Real Estate is a very interesting company because by the look, when you look it up on Yahoo or anything like that, it'll say it's a healthcare REIT, or it'll say it's an office REIT, and you might not be sure which one it is. Well, it's a little bit of both. Alexandria Real Estate is a real estate investment trust that specializes in leasing out space to the health research technology, biotech industry, basically health campus, research campuses, biomedical, research facilities, pharmaceutical labs, things like that. Basically anybody that is going to be associated with lab work and, some sort of lab and office hybrid. It's an interesting concept because I think they're one of the unique niches in the real estate investment trust space, in that they're kind of office work because this is all selling to businesses who are looking for office space, but also in the healthcare space because it's labs. And it was kind of a unique concept that a lot of people have looked at, because like these, if you're custom building labs and things like that and research facilities, they tend to have a little bit better occupancy. They tend to have a little bit better pricing because, somebody who's a pharmaceutical company who's looking for clean rooms and like all the ventilation necessary for a healthcare facility, you have much fewer options than, your generic business office with a bullpen and things like that. So it's a unique business model, and I think there are some benefits to it. As far as the business itself, it's been an okay business. I wouldn't say it's the most spectacular business, but again, we're talking about real estate investment trusts. Some have done much better than others. One of the things that I've kind of noted is the downfall or the disadvantage of this particular type of investment is when you are making development investments, when you are making acquisitions, these are inherently going to be more expensive than your typical real estate, your office real estate or anything like that. Making the installations in all of the HVAC facilities, the electric work that goes into these sort of research facilities is going to be much more technically demanding than, generic office park, and therefore your costs are going to be higher, and sometimes that may not necessarily reflect in their rent. And I think that's kind of been the case with Alexandria Real Estate over the years, that they've done an okay job of growing. From a growth perspective, it's been okay. From a solvency, it's fine. I can't say there's anything spectacularly right or wrong about it. I think they've done a relatively good job. It's been a little bit underwhelming, I guess, in my sense. Over the past 10 years, it's had a total return of 49%. One of the reasons I think that has been the case is this is just not, it hasn't proven itself to be necessarily a market beating type of investment. And I think a lot of people may have viewed it as such, with that kind of bullish thesis that I was mentioning, especially during the pandemic, because everyone was looking at office real estate and being like, oh, who's ever going to rent office space ever again? But healthcare, they can't really work from home, right? Because you can't do lab tests from home. So that there was that thesis there. I don't know how much that has worked out, but with a current dividend of 5.15, a dividend yield of 5.15%, that's a little bit more of an attractive position than what it has been in the past. Historically, this is a business that's grown its dividend by 5-6% annually over the past 10 years, which is, it's okay. It's fine. But when it comes to real estate investment trusts, you're buying for yield and a little bit of growth. It's kind of like a little bit better than bond type of investment that's not typically correlated with the returns of the stock market. So you're getting a little bit of diversity in publicly traded real estate. But if your business is growing for 5 to 6% annually, or growing its dividend, you can kind of expect that the stock's going to more or less grow at 5 or 6% annually. That's valuation aside. And so with that in mind, when we were having this, when people were buying this company with a 2 to 3% dividend yield, that doesn't leave a lot of room for growth. You're kind of baking in this idea of much faster growth than what this company has historically produced. And so I think for a big reason why the past few years this company's price has, struggled a little bit and the yield has gone up, which, yield goes up when price goes down. That probably a big part of it, like higher interest rates, a lot of like macro considerations when you talk about real estate, which is going to be a slower growing investment than, tech stocks or things like that. However, at a dividend yield today of 5.15% with, if we can reasonably assume a 5% growth, that's a much more attractive position I guess you could say entry point relative to what they have done in the past. This is a business, like I said, it's more or less generated market returns over its long-term average. And if you want to beat the market, I guess, if you will, with this sort of company, you have to be hypersensitive to valuation. At a 5% dividend yield, which is relatively high historically speaking for them, might be one of the better times relative to what we've seen in the past.
Is there any specific REIT that you hold or that you like at the moment?
There's a few. I've been kind of fishing in the REIT waters a little bit lately. I've been looking really hard at retail REITs for the most part, because I think the idea of the kind of the retail apocalypse thought that we had in the 2010s, where e-commerce was just going to destroy retail real estate, hasn't really borne out. I think that a lot of companies are kind of going back to the roots of brick and mortar, because they're finding there's the challenges of e-commerce, especially with things like reverse logistics on returns and things like that, is so prohibitively expensive. It's nice to have that bricks and mortar footprint to get in front of your customers, to be available to your customers for that part of the transaction. It also makes it less costly for them. That touch point has always been a little bit better. And also from just the real estate aspect of it, in the United States, it's been like 30 years and we've had like zero square footage. Not zero. It's been 0 to 1% annualized growth in retail real estate. It's been one of the slowest growing sectors for the past 30 years. And so a lot of those like old decrepit regional malls that everyone was talking about during the retail apocalypse, they're gone. And what's been left has been better placed, better amenitized facilities. And a lot of the retail real estate has been looking better. And so this is a place I've been fishing and been looking for new investment opportunities. As far as actual ownership, I own a lot of industrial real estate. The two that I like the most in industrial in particular are Rexford Industrial Realty and Torrento Realty, two what I would say are some of the best managed ones in this business, because they are intently focused on growing per share value rather than just growing the entire footprint of their facility and kind of being the empire grower, which is one of the, I would say, the biggest challenges for identifying good real estate investments, because so many people just associate growth as good when per share growth or per share value is more important.
Okay, interesting. I mean, the only one that I have looked at a while ago is Vichy, because of the concentration in Vegas and the casinos and resorts and all of that. But at the moment, it does not fit my portfolio for obvious reasons. But in the future, I mean, could definitely be a solid point of interest for me. There was a question we can both answer from. No, I forgot who asked this. From Vihan 13 minutes ago. Anything that caught your attention and added to with recent volatility, if able to speak on positions added and your watch list?
I'm going to have to default to you, because I've actually been out of the loop for about past week. A little bit of holiday, a little bit of children on vacation. So I haven't seen as many. I haven't been I'm not super intent on what pricing and valuation are looking for a lot of things. I mean, I mentioned a couple already. Like I mentioned First Solar. This is actually a company I've been pretty intent on watching as of late because of pricing and valuation, and where I think the long-term prospects of the company are going. Others I'm less adamant to give any like firm opinions on right now, for the simple fact that, like I said, I've been away. I need to kind of get caught up on things, but I can say First Solar with a little bit of conviction, much more so than a lot of other things. What about you?
Fair enough. I did do some shopping in the last week and a half. Not going to talk about what happened in the last 2 days, but before that, added to more positions that I had just because I wanted to build up those positions. So semiconductors, for example, AMD, my fintech positions. I still like PayPal quite a lot. A SoFi, for example, as well. Did add to Walt Disney. So there are some non-tech companies in the portfolio. Walt Disney is one of them. And other than that I can talk about, I think that's it. I think I've been focusing on the semiconductors and the fintech space more recently with the volatility in the market. Now, whether we have hit a bottom or not, I don't know. I just like the value that I'm getting from those companies at the moment. I tend to hold those for a long period of time. So if in my eyes I see deals, then I'll take them. So yeah, those are the companies that I can talk about that I've been picking up more recently.
Sure. Just to answer Vihan's question that just came in right now, to confirm the tickers on the ones that I had just mentioned in industrial real estate. He was asking about the tickers. Rexford Industrial Realty is the ticker is REXR, and Torrento Realty, the ticker is TRNO. So anybody who was curious about those particular ones that I own personally, just wanted to get that out. And then Tim, I hope I don't mispronounce your name. I apologize if I do. Is it Tim Youngles or Jungles? I'm sorry if I pronounced it wrong. How do you feel about BXP, which used to be called Boston Properties, but changed its name to its ticker recently for reasons I'm not 100% certain of. You never know why companies actually change their name or anything like that. But so BXP, Boston Properties, is an office REIT, a little bit more of a, bread and butter office REIT that we think of. Large Class A skyscraper type buildings, large buildings trying to, in metropolitan areas, not like, we'll call them like office parks in suburban areas. These are kind of like prestige offices, the things that you like have in like a midtown Manhattan for a law office because you want to impress your clients or something like that. That kind of office building. So relative to the other things in this space, I mean, office REITs have been a very challenging space. Admittedly, has been getting a lot better as of late over the past few years, especially in Class A urban office REITs. Those have been a better place than, like I said, kind of generic Class B real estate, maybe in less desirable locations. So there has been some benefits to that. The one thing that has been challenging for BXP recently is that despite the fact that, the real estate market for this type of for this type of real estate has been improving, BXP's financials have still been deteriorating. Its total debt to EBITDA right now is 8.9 times. Even in a highly levered industry like real estate, this is probably a little on the high side and doesn't leave a lot of room for growth. You're much more in kind of like a manage the debt sort of situation. I think it's even at a point where probably debt reduction or debt refinancing needs to be a priority for the company. And also, if you look at despite the fact, yes, the dividend is at 5.68%, but it hasn't moved they haven't increased it since 2019. And understandable reasons why. I mean, at least they didn't cut it. I'll give them that credit during pandemic and kind of the subsequent work from home, termination of leases. They've been able to kind of work their way through that. But it hasn't, even before 2019, this wasn't exactly a business that was growing its dividend at very, very high rates. And so with all of that in mind, there's part of me that says I would really like to see this business do some balance sheet repair before I would really consider this. At a debt level that high, we're very much in a restructuring, debt reduction sort of thing, which is never a great, you get that it's supposed to be levered a component of, it's supposed to have lots of debt, but even by that standards, this is a little too high for me. So this is a business I would like to revisit at a much later time once we see some improvements on the balance sheet. And thanks for the correction on the pronunciation, Tim. I'll get it right next time.
It's a funny correction too, yeah. Okay, touching on the last part that you said here in your answer, are there any more of those companies that you're like, if the balance sheet looks better in a year from now, if macro looks better, then it might go from a watch list to buy list?
This is one that I've had a lot of mixed feelings about, and that's EPR Properties. This is also, it's an entertainment-esque type real. They call it experiential properties. So they own their largest component is movie theaters, but they also own ski resorts. They own a lot of Top Golf, entertainment facilities and things like that. Obviously they were a big component of Regal Cinemas, which went bankrupt. And so there was a lot of restructuring revolved around that. And as a result, they've had relatively high debt. Pandemic was just atrocious for them. Aside from just Regal, pretty much everything for them was hit pretty hard. And so they've been trying to restructure the portfolio, minimizing its hotel exposure, trying to also get out of it had some properties that it actually operated themselves, like hotels that they owned and operated, rather than just like leasing it out to a hotel operator, like a Marriott, Hilton, or something like that. And so it's also a business that's had relatively high debt load, and I would like to see it. It's kind of like a wait and see sort of business for me. I'd like to see that more progress on the managing its cinema portfolio, a little bit of management of the debt situation, but kind of the same thing. It's like there's a lot of wait and see in this business before I would make a firm commitment to this in that sort of a way. It's certainly one that I've gone back and forth with some colleagues a lot, because there's certainly a lot more people in the who are much more bullish on EPR than I am.
Okay, no, fair enough. Let's see. If you have a question, you can put it up. I'm scrolling here.
Let me see. Yeah, I can hit a couple. We'll get some leftover ones that I checked in on before we got in. So let me see if I can dig them up really quick, unless you find something right away. But this was one that I know I had in the hopper. Apologies. This is great. Here it is. Yes.
Yeah.
No, go ahead. Please do. I'm on for another hour. So if you got a question, take it.
It's from Javier. 43 minutes ago, what are your thoughts on CrowdStrike and Fortinet, so two players in the cybersecurity space? For what I've seen, those are two the ones I like the most inside cybersecurity. So both of them have been performing quite well. It's in the cybersecurity space. What I've seen is that a lot of these players, the popular names, are not cheap. They're not cheap at all. Because their stock have risen quite a lot in the last year. For example, Fortinet, ticker symbol FTNT, is up 42% in the last year. Has been a small pullback, like with many of the stocks this year. But the company top line growth, 13% or so, is the expected growth rate for the next 2 fiscal years. EPS growing a bit slower than that. It has a market cap of $77.8 billion. A forward PE at the moment, I'm seeing here 41 times. So definitely not the cheapest one out there. Now, of course, when you compare it to a CrowdStrike, for example, CrowdStrike is at a market cap of $82 billion and a forward PE of 96.5 times, which, again, not the cheapest one out there, but usually you pay a premium to get the best in class. With CrowdStrike, of course, a year ago, there was that outage that, took the stock down quite quickly back in July of 2024. They did an update, didn't work as intended. So huge outage on, I think, July 18 or July 19th of last year. But actually since then, up until the most recent earnings report, the stock actually recovered all of the losses and then some. They also showed that in the last 2-3 quarters or so, the business was still doing well. So the market reacted accordingly and said, you look, even with an outage of that magnitude, companies still managed to do quite well. Now, more recently, actually since the most recent earnings report, stock went down a bit more than 20-25% or so, which means that it was even more expensive before. But if I had to choose, and I don't own any of those names, if I had to choose, I'd still put CrowdStrike over a Fortinet, even if it is more expensive right now. But it is the best in class, so I am willing to pay a small premium. Plus, it's also expected to grow faster than a Fortinet. But yes, there are still some after effects, negative after effects from that outage that we'll probably see in the upcoming quarters. But if I had to choose, it's probably CrowdStrike, then Fortinet, and maybe I'll even put a Palo Alto Networks in there as well.
So I'm going to hit one question, and I think that might bring us to the end here. But maybe I think this might be we can broaden this out to a more general question that maybe Neil, you can touch on as well. But RH asked about any thoughts on UTG. It's a utility energy income fund. Their dividend is monthly and was 19 cents for the past in February 2025. So just doing a quick glance, I was able to do a little bit of research while Neil was discussing, talking about this last one. And here's the thing. So utility income fund, this is a mutual fund. This is not a public, this isn't a stock. This isn't an ETF. This isn't an index fund or something. This is going to be a specifically actively managed fund that is going to take an expense ratio. Reeves Utility Income Fund is a income fund that has a net expense ratio of 2.23%. So that's not uncommon when it comes to mutual funds. That's 2% is a pretty common fee that you have for mutual funds. But that is, when you think of it in the longer, if you think about it in the grand scheme of things, there are other opportunities to get exposure to utilities that don't have nearly as high of the expense ratios. Which one of the most important things, or I say one of the more underappreciated aspects of investing is fees. We don't think about them as much anymore because ETFs have become so prevalent, index funds, because they are these low-cost mechanisms for investing these days, which is, we don't think about it nearly as much as we used to. But prior to like I would say like prior to the 2010s, how much you paid for things like mutual funds was a very, very large component of sometimes a fee that you didn't even realize you were paying. If you own something for 10, 20 years and you're paying a 2% management fund, it is extraordinarily expensive. And as a result, it can cut into your returns. So just to give a perspective difference. So I just said Reeves Utility Income Fund had a fee, a management fee of 2.23%. I want to compare it to one of the largest utility index funds out there. This is called the Utilities SPDR ETF. The ticker is XLU. This is, like I said, largest fund. It benchmarks the S&P Utilities Select Sector Index. So, index fund mostly in things like NextEra Energy, Southern Company, the largest utilities in the United States, right? This has a total expense ratio, again, is a 0.09%. And so even if it would take Reeves, the UTG, the one that was asked about, it would take extraordinary outperformance from this particular utility income fund to outpace an index fund that has a expense ratio that's 2.1% lower every year. So basically, the Reeves income fund has to do 2% better every year to beat just investing in an index fund. That is it doesn't sound like much, but over decades, that is an extraordinary amount of outperformance that can be hard to do. And so if you're looking, not to be too broad-based, there are good opportunities to get into mutual funds. I'm not going to say that they're all awful, but in terms of relative to performance, the Reeves Income Fund relative to the utilities ETF, they've been more or less the same over the past 25 years, but you're getting that 2% management fund cut out every single time versus 0.09% for your XLU utilities index ETF. So when you are looking at mutual funds, it would behoove you to just go and see what would be some of the similar index products out there that could replicate what you're trying to do with this same mutual fund. And would it be, has the performance been similar enough that, the mutual fund isn't worth its additional expenses?
I mean,
Neil, I don't know if you had any thoughts on mutual funds versus index funds or anything like that, but
I think now I can plug in the Charlie Munger quote here as well.
yeah, nothing to add. Okay. Well, with about a minute left, you got one last question you want to hit before you head out?
No, a general one. Maybe we're at the end of the earnings season. Maybe are there any specific companies that you're still looking forward to their earnings reports?
I would say a couple I haven't. Can't remember if they've reported or not yet. That's a great question. There's one I haven't read through enough yet, but one that I have been following quite a bit, and I want to dig deeper into, is Quantumscape. This is a solid state battery company. It's been a fascinating story to follow. Kind of went from what I would say is a glorified publicly traded science experiment to what is looking like to be on the precipice of an actual business. So I would like to dive deep. The reports themselves have actually become quite bland, all things considered, because it's they've more or less done what they said they were going to do. And so there's not been a whole lot of surprises, but considering, there is a ticking clock with a business that is pre-revenue, and there's a lot of companies coming up to meet the challenge of solid state batteries. I'd like to see if they are on track and if they can, meet some of their commercialization goals that they're expecting to hit, I believe, next year. So that's one I want to dive deep into, especially maybe not with the earnings report, but definitely when the annual report 10K hits in the SEC filings.
Okay, no, fair enough. I don't know if they report already or not, but no, fair enough. Interesting, definitely interesting company. I've seen that name pop up a couple of times.
Yeah. So what about you? What's the one that's got a really itching to really dig into?
There are two. I mean, on Monday after the market closes, Oracle reports earnings, so that's an interesting one. And then I think on Wednesday there is Adobe. I don't hold any of them, but I would love to hear what they have to say on, well, Adobe, their monetization of their AI credits and all of that, and Oracle, of course, still CapEx spend, cloud build out, and all of that juicy information. So those two companies on the watch list for the week.
Well, and with that brings us to top of the hour, and that will be Neil is going to get tapped out, and or Rachel's going to tap in for the next hour here. So Neil, thanks for that, and we'll see you next time. Rachel, yep. How are you? It's been a minute since we've. Looks
okay.
Like
Tyler.
Yeah, they kicked me out and then
lost you
put me
for a
back in
minute.
for a second. Yeah.
It has been a minute. I'm doing good. How are you?
I'm doing well. So for the top of the hour, we should do the obligatory disclosures just in case for people just joining us.
Yes.
Obviously, this is a educational only discussion that we're going to have here and please do not take anything that we say to be misconstrued as individual personalized advice. If you are looking for personal advice, please go consult a professional. This is entertainment, education. We're here to share our views, our thoughts, our expertise, but please don't misconstrue that for advice. And for those of you who are joining us from YouTube, please go to slido.com and enter the code Fool24. If you want to get questions in, we have a question board there available to anybody who wants to ask questions. It is moderated to keep things nice and polite, and we welcome your questions there. Rachel, like I said, ask us anything. We were maybe a little less organized than most people. That's my fault for being away and very offline for a few days. So, yeah, we're going to do a little less structured. I don't know if there was any news stories or anything like that you hit, or maybe there was some questions already in the queues that you were just like, let's jump right in. And so if there's anything you've been looking at and you want to hit really quick, or where do you want to start?
Yeah, there were a couple questions that came in that I thought were interesting that I wanted to grab. One was from Ed talking about international investing. We hear about the Canadian, Mexican markets, Japan, China, the EU. We rarely hear about India. Why is that? I think that there is a lot of opportunity in that space. I don't follow the Indian market as closely, but there are a couple companies that I do. One of them is Reliance Industries. They're traded on the National Stock Exchange in India. Another one is Enphase, which actually trades on, I believe, the New York Stock Exchange. So they trade on a US exchange. But Reliance Industries, which is one company I follow in this space, they have a very diversified business portfolio. They have one of their businesses is an oil to chemicals business. So includes refining, petrochemicals, oil and gas is a major revenue driver of their business. Then they have a retail segment of their business as well, which includes just a vast network of retail stores, e-commerce platforms where they sell, consumer goods like groceries, electronics, apparel. They also have a digital services segment, which is called Geo Platforms, also under the umbrella of Reliance Industries. And that is a segment that generates revenue in a few different ways, including through telecom subscriptions, digital content, broadband services. They have a wide range of operations that also stretch into areas like oil and gas exploration, media. It's an interesting business, one I follow a little bit. So one I wanted to bring up. Enphase, they're known for their consulting IT services and outsourcing services, which they also earn revenue from. But, another way as well for investors that are looking at different international companies, we talk about those sometimes on the show, especially with Tyler and myself, as we're both based outside of the US. And we tend to look at a lot of different markets in our day-to-day research. There's exchange traded funds can be a really interesting way to invest in different markets without maybe being overly concentrated in a particular stock or business. So for example, with the Indian market, there's actually an iShares ETF called iShares India 50, and that's traded on the NASDAQ under the ticker INDY. So those are some ones that I watch and follow that might be of interest, for anyone who's looking at this space and maybe wants to delve a little bit further. The other question that I also wanted to hit, we had one come in from Lou. I think they had asked this a couple times, and I wanted to get to this. I talked about Eli Lilly a bit earlier today, but the question was, Eli Lilly's valuation seems high. Where would you consider buying in? So you are right that this is a pretty high valuation the company is trading at right now. For anyone who's not familiar, their current price to earnings is about 74. They are trading at historical highs for the business. There have been a lot of factors that have driven the stock upward. The shares are trading up more than 500% over the last 5 years alone. A lot of that has been down to the company's success within the GLP-1 drug boom. And that is something that continues to be a real, I think, significant tailwind as well as growth driver for the business. But those are not the only growth factors for this company. Something I mentioned earlier today when I was talking about this business, this is one of the oldest pharmaceutical companies in the world that is still in existence. They have been around since the 1800s. They've actually paid a dividend in some form since the year 1885. And they have had a really steady habit of growing their financial growth as well as shareholder returns through time. It's been a really steady business to hold. This is one that I am a shareholder in. They're known not just for their GLP-1 drugs. They are a long-standing leader within the diabetes care space with drugs like Trulicity. They are also a leading player within the oncology drug space. Verzenio which is a well-known competitor to Pfizer's Ibrance. It's a CDK4/6 inhibitor. That's just one example of their broad and growing oncology portfolio. A couple things that have been going on recently that I think have also, been factors in the company's success, and I think continue to draw a lot of interest, in the stock. One was the approval of Kisunla, which is the brand name for their Alzheimer's drug for early onset Alzheimer's. Without getting too into the weeds, it targets what are called amyloid beta plaques in the brain, and these are believed to contribute to Alzheimer's disease. And essentially, Kisunla is an antibody that binds to these plaques and then helps remove them from the brain. So it's currently approved for the treatment of early symptomatic Alzheimer's disease, including mild cognitive impairment and mild dementia. It's administered as an IV infusion every 4 weeks. It's still being approved in numerous key markets. In the company's Q4 results, management noted that Kisunla had just been approved in China, which was another big win for the business. Another major drug to watch with them that I think has significant blockbuster potential is Omvo. That's a drug that was first approved back in 2023 as a first-in-class treatment for adults with moderate to severe active ulcerative colitis. And then in January of this year, the FDA expanded its approval to moderate to severe active Crohn's disease in adults. This is, again, a disruptive potential drug in this treatment space. This is a business that, when you look at it, the valuation is significant. I can't say whether or not share prices, might come down if, in fact, we continue to see more volatility in the markets. That could put some downward pressure on the stock. For me personally, something I've talked about a lot is a high valuation doesn't keep me away from a great stock. I think that a lot of the incredible growth that the company has been delivering, their GAAP profits grew more than 100% in Q4 of 2024 alone. A lot of that growth is baked into the stock right now. I think that valuation is justified based on the growth we're seeing. I think at some point that growth will moderate. But this is, I think, a business that for anyone that's interested in the healthcare space, that it was, looking at for very profitable, established healthcare businesses that also have a lot of growth tailwinds. And Eli Lilly is definitely growing at a significantly, above average rate than the average pharma stock. Low double-digit revenue growth is really exceptional for many established pharma businesses of this kind, and Eli Lilly has well superseded that. So valuation's high, really solid business in my view. Investors will have to decide for themselves whether or not that valuation makes sense for their personal portfolio. For me, this is one I plan to hold for a long time and hope to add shares to, in the future.
I'm gonna cop out on the
That's all
Eli
good.
Lilly discussion, but going back to the Indian market one really quick. As far as why that is, that's a great question. I'm not 100% certain. I'm just going to speculate. Familiarity with markets, things like that, and I would have to look a little bit more into like disclosures and like ability to get information like that. One industry in particular in the Indian market that has always kind of caught my eye is the generics pharmaceutical industry there. Kind of one of the major benefits of when a company goes off patent, you have all of these like generics that flood the market, and it's like the boogeyman for pharmaceuticals. Well, they're the boogeyman. They're the generic makers that will basically take this well-established science, recreate it, and then build a generic for fractions of the price. It's an industry that I've become fascinated with, and the one company that I have kind of got introduced to it, and the reason I follow this one a little bit more is they have one Dr. Reddy's Laboratories is publicly traded on the U.S. exchanges, and so it has to make disclosures to the U.S. to the Securities and Exchange Commission and follow all the SEC rulings. So because of that specifically, I've been interested in that one a little bit more than some of the other ones. Granted, Dr. Reddy's hasn't been the best performing of the Indian pharmaceuticals, but I don't know. There's just something to be said about having the assurances of disclosures and following the rules that and can make reasonable assumptions with. The Indian market has been kind of a little bit on my it's stacking up on my to-do pile, because it's definitely a market that I want to look into a little bit more, because of probably a lot of the reasons why the question was asked, like why not? Because it's a fast-growing market, strong growing GDP. GDP per capita is growing, probably one of the fastest growing countries in terms of that, in terms of population growth and all that stuff. So a very interesting market that I should spend more time with, but we can only spend so much time on everything.
I know.
So
I feel that. I will say they're, I'm sure you know this, they're known as the pharmacy of the world. India's generic pharmaceutical markets supplies over 50%
fascinating cottage industry.
Generic drugs by volume. Yeah. And 20% of the world's generic drugs, globally. It's pretty impressive.
Yeah, just an anecdotal. My wife ran a pharmaceutical supply chain project in sub-Saharan Africa for a while, and the amount of Indian pharmaceutical drugs that were being moved was spectacular. Whether it be HIV antivirals, malaria drugs, a lot of schistosomiasis, a lot of like the tropical disease sort of drugs. It was a fascinating case study, just watching from the anecdotal, watching like moving all this product through the supply chains. But yeah, from a performance perspective, it's been a very interesting market as well. So while Rachel was talking about Eli Lilly, I had a chance to look through some questions and picked out this one. I wouldn't say I'm the strongest analyst on this one, but I'm going to do my best to try to answer it anyways. Players Luck asked about 35 minutes ago, said, any comments, well, foolish comments, because we are Motley Fool, comments on ticker Toast. Ticker is TOST. The company is Toast. So this is a company that builds restaurant point of sales, and also other retail businesses point of sales. There's a reason they have that acronym for anybody who waited tables or did anything in the service industry. They tend to be a real pain in the butt. At least from my experiences when I was waiting tables. I didn't get to use Toast because I've been out of it since they got started, but it's an interesting business. Obviously, if you look at its financials, revenue has grown at a spectacular level. I think the investment thesis that a lot of people make is say that, if you can get somebody to convert to your point of sale system, like Toast has been trying to do, it's a sticky relationship, right? Management teams are going to be reluctant to change over to a different point of sale system once you have it in place, because you have to retrain all your staff and all that stuff. And, disruptions at a restaurant or anything like that can, not a lot of customers tend to be very forgiving. If be like, sorry, we don't know our point of sale system, and, we missed your order or something like that. That can ruin your business pretty fast. So that's kind of like the thesis behind it. It's like, well, if you can get these people to sign up, it's a very sticky relationship, and, it should lead to pretty good profitability. And, on a revenue growth side, that has, they have been gaining market share at a relatively rapid pace. The one thing I would say about that, though, is they have had very, very high customer acquisition costs. And I think part of the reason it has been able to grow market share so quickly is because it's been underpricing its product relative to the market, and it has been, it has had high customer acquisition costs because that very reason. Switching in this industry is extremely hard. And so trying to get people to sign up for them is going to be a costly endeavor for you as the company to get that done. And so it's worked to a degree, but for a business that it went public in 2021, but I can look at its financials a little bit further back, going back as far as 2019. Like I said, revenue has been good, but it has just this past year, in fiscal year 2024, we saw the first inklings of profitability. Fiscal year 2024, we got 3 cents per share earnings per share, and I think that I don't even know if that's on a continuing basis or not. There might be some special exemptions in there as well, but it just kind of goes to show that this is a business that's struggling with profitability because of the customer acquisition cost. Whether or not, it gets to some sort of set market saturation. Between Toast, between Block, and between some of the other, vertically integrated software companies that have options in this space, how much more that Toast can take from others is a valid question. It's still growing at a revenue at 28% annually, or at least year over year. So that's somewhat promising. Maybe they can do it from higher pricing as like some of those initial lower costs to get people in the door start to roll over. Maybe you can gain a little bit more market share. That's kind of drifting a little bit past my level of expertise on this company, but there's just a couple holes that I always kind of wonder about this. Is like, well, if somebody can come in with very, very high customer acquisition costs and take market share of this quickly, what is stopping from somebody else from doing that? I know the thesis is that switching costs are high, but Toast was able to do it. What is going to stop the next person from doing this? And then the other thing that scares me about Toast a little bit, and this is kind of a personal affliction, I guess, towards certain stocks, is their stock-based compensation is absurd. I can't sugarcoat it in any other way. In the past year, they had $67 million in operating income. And they had $250 million in stock-based compensation. Past 3 years, they've had over $250 million in stock-based compensation for a business that just barely, broke even on a profitability scale this year. And this is a business that, like I said, I've got financials going back to 2019. I think they've been around even longer than that. How much can a business that shells out that much in stock-based comp, I don't know. For me, that's always been a great, a holding up point for a lot of businesses, because when you're handing out that much stock-based comp, beside the impact on the free cash flow or the income statement or anything like that, it is eating away at you, the minority investors, per share value or future value that you have. You can do all the discounted cash flows in the world and look at all of the stuff, but if you know that every single year management is going to reduce your per share value through dilution with stock-based compensation for its management, for its sales team, for anybody involved, it becomes a less attractive thing. The company has to grow that much faster to accommodate for all that additional stock-based compensation. It's one of those underappreciated things where everyone's like, well, it's a non-cash thing. No, but you have to pay the bill eventually, and that comes in longer term per share value growth for your business. So I guess maybe not the most complete analysis of Toast, but that's kind of the few things that I have observed of this company over the couple of years of reading other people's things and kind of making my own assessment.
Yeah, I actually follow this company pretty closely, and so I'll add a few comments too. And I agree with what you're saying. Looking at these businesses, you often see that really high level of stock-based comp, and it's something that always bothers me. It's often part of the price of admission with these types of businesses, but definitely something to be aware of. They have an interesting model that I think is really sticky. Just to give a little background, I mean, they were founded back in 2011, right? Went public a couple years ago. As of the end of 2024, they had about 134,000 restaurants that their, products, software, and hardware were live at, and they are estimated to control about 25% of the point of sale systems market. So pretty significant. This is a very fragmented space, but certainly gives them, room to run. One of the things that I think is interesting about their particular value proposition to these restaurants is they really provide these all-in-one integrated solutions, right? So there's their point of sale products and restaurant operations. And this includes software that runs, fixed location point of sale terminals, handheld point of sale devices, as well as self-service kiosks that allow restaurant staff to take orders and guests to pay. They also provide marketing products to help restaurants deliver targeted email and, text campaigns. They have software solutions that help facilitate the online order and delivery process, including Toast provided solutions as well as integrating with third-party ordering channels. And then all of the stuff that goes on behind the scenes, like payroll, team management, vendor management offerings, they also have software solutions for that. They have as well a retail solution that is essentially helping restaurants, but also outside of the restaurant space, convenience stores, grocery stores, even bottle shops to streamline their inventory management. They have something called Smart Scan technology, which enables these operators to scan an item's barcode with their mobile device, put that key information into their point of sale, as well as an AI-generated recommended description. And then they have a range of fintech solutions that they offer restaurants, including they have Toast Capital, which offers eligible restaurants access to flexible funding via loans that are issued by their bank partners. And those loans are then repaid through a portion of their daily transactions. And I think, I might be wrong on this, but I think Toast also maybe earns a little money from interest on those loans. So really a wide-ranging business model in terms of how they make revenue. All of those different products and services I mentioned that really boil down to software solutions, hardware solutions, fintech solutions. They make a major part of their revenue from payment processing fees, so percentages of transactions that are made using their solutions. They also make money, of course, from software subscription fees, recurring revenue in that way. They sell their point of sales hardware like tablets and peripherals to restaurants, so they make some revenue that way. And then these different services also produce different fees. Just to kind of put some numbers to where this business is, to kind of just close out the thought here. So they reported their 2024 earnings in February. Their gross payment volume for 2024 was up 26% year over year to about 159 billion. Their GAAP subscription services and financial technology solutions gross profit was up 34% year over year. GAAP net income was 19 million in 2024 compared to a net loss of 246 million a year ago. So as Tyler noted, that was their first year of GAAP profitability. And then they delivered about 306 million in free cash flow in 2024. And as I mentioned, they ended the year with about 134,000 locations, and their annualized recurring run rate increased 34% year over year to 1.6 billion as of the end of 2024. Total revenue for the 12-month period was about 4.9 billion, just shy of 5 billion. Compared to about 3.9 billion a year ago. So this is a business that I like. I think the idea that switching costs are high, I do think that's a sticky proposition for this. I also think that looking at this space, there is room for multiple winners. I think Toast has definitely been one so far. I personally, I think there's a lot of room for this business to run. I'm waiting to see a little bit more of established profitability before I personally take a position. Something I've mentioned on other shows talking about this business as well is just the concept of, even if you're in a situation where the macro environment has shifted and restaurant sales are down, obviously that would impact Toast. They make a huge part of their money from cuts of each transaction, but at the same time, these restaurants can't necessarily afford to just completely remove their entire software and hardware infrastructure, which is essentially what Toast provides. So I think in many ways, this could be a somewhat slightly more resilient way to invest in the restaurant space than investing in restaurant stocks themselves. So interesting business for sure. Oh, hold on. I think we're muted. Either that or I lost my sound.
Nope, that's me. That was me. So this was a question Vihan asked 32 minutes ago, and I think we can twist this into a little bit of a more general question that I think we can both maybe talk about, like experiences as investors with a particular company that fits this mold. But Vihan asked, say you have a company and he uses ticker BOC, which is Boston Omaha, like this. Thesis shaken and stock is down, I'm assuming 50% from the position that somebody took in it. Would you dollar cost average your position, hold multiple quarters for a turnaround, or sell and look for opportunity at other opportunities? So obviously, I think this varies, but I think what I would like to do for this question is maybe walk through a situation with a company that is in my portfolio right now that is in a similar situation. My position is down like 59% from when I bought it. And the company that I have in my portfolio that does this, company's called Hexatronic Group. It trades on the Stockholm Exchange. Ticker is HTRO on the Stockholm Exchange. This is a company that builds fiber optic cables and other fiber optic connectivity devices and things like that. For, three components are fiber to the home, so residential fiber installation, and the generic network for fiber, harsh environment stuff, so a lot of undersea cables as well, especially for not just data transmission, but also surprisingly for some other components for oil and gas industry, as well as undersea cable for transatlantic undersea cables and some of those. And also they've just built out a data center solution, so it's like a little bit, we'll call it higher technology, or higher specification, if you will, fiber connectivity for faster speeds, lower latency, things that you're demanding from data center. This is a business, like I said, my position is about down 59%. And the core reason for that has been, this was a business that was growing a lot with spending on rural fiber deployment, not just in Europe, but internationally. They actually have a very, very large presence in the United States on the fiber to the home initiatives that started under the Biden administration. The reason that it has slowed down so much is obviously some of the deployment of those funds has been delayed, canceled, whatever, but also higher interest rates has severely slowed down the deployment of kind of residential fiber to the home, the kind of the more bread and butter generic components of fiber cable deployment and connectivity. So that has certainly hurt the business and slowed down its growth. Perhaps the largest reason, on top of a high valuation at the point I purchased this company, and why it's down so significantly. The reason, and for this one, and the thing that I have been doing is I made an initial position, I added to the position about a year later, and then since then it's been very much in a holding pattern, kind of waiting. And the reason that I continue to hold it is, not necessarily from the fiber to the home, because I think that's still a part of the company that's going to struggle, but its harsh environment and its data center aspects of the business have been growing significantly, albeit smaller positions in this company. So this is, for this particular example, despite it being down as much as it is, there are a lot of bright spots in the company that I want to see how it goes over multiple quarters. So it's a position like, despite it being down so much, I really think that the company's trajectory still looks good over the long term. I think there's a lot of opportunity in deployment of fiber on all aspects, but more so in the data center, AI connectivity, low latency movement of data that is going to make this particular business go well. And so in this particular case, this is something that I'm just going to kind of sit around, see what happens. I'll watch a few more quarterly reports, track its progress in these things. And something that I plan to hold, what could shake the thesis is if those other bright, green shoot components of the business start to stall out, while, fiber for the home is not doing as well either, then maybe it's time to look for other opportunities elsewhere. Do you have an example of something that's like really, way down or kind of shaking your confidence, and how have you worked through it?
Yeah, well, I've talked about this a bit, but years ago, when during the pandemic boom, I think, like a lot of investors, I bought shares of Teladoc. That is now a very, very, very small portion of my portfolio. It was a much bigger portion of my portfolio at the time when I invested and had a really strong thesis for the company. I actually don't know the percentage by which I am down since I first bought. I'm curious if I can look that up right now. I think I'm down almost 100% from when I bought Teladoc. So it's just so fun. But the thing is, that's a great example. I kind of joked when I was talking about this company the other day that I now have a really very small position of this still in my portfolio. I sort of do that as like my play money for fun, to see how and when and if the stock ever recovers. I wanted to have just like a small piece of the action, nothing like what I had invested years ago. And for me, I mean, this is a prime example. This was a very, very gradual process for me of my thesis becoming shaken and then changing entirely. I think, like a lot of people, when I first bought into the company, I had tremendous confidence in its ability to be a key player within the global telehealth industry. I still like the platform and the business and the concept of it. There is still a significant and growing need for the types of products and solutions that companies like Teladoc provide. But I think what we have seen as the space has evolved in the years since, you think of a company like Hims and Hers Health, where telehealth is a part of their platform, but they make most of their money from subscriptions that come from consumers, individual patients who pay to be able to have recurring access to the platform and also access recurring deliveries of their, vital drugs and prescriptions and so forth. And that kind of a model, I think, is much more resilient and has proven to be so over the long term. Whereas a company like Teladoc that was focused so wholly on telehealth, they made a number of acquisitions that they massively overpaid for that have plunged the company into deep unprofitability from which they have yet to recover. They most recently announced that they were making another acquisition, which I'm not even sure how that's going to grow or improve the company's growth story over the next few years. It wasn't like a quarter or two of financial reports for me, though, that shook the thesis. It was several in a row. Watching the trajectory of the business over time, I lost confidence in what I felt management's vision for the company would be and in their ability to turn to right the ship, so to speak. So that's a great example for me of one that had a very high conviction in, held onto it for a very, very long time, and even as shares continued to plunge, and very slowly my thesis shifted. It was a great lesson, though, and that's something that I think that happens as investors, and especially investors who are putting cash into companies, for the long term. That's a situation where inevitably not every stock we pick is going to be a winner individually. And I think that's where the importance of diversifying comes in. My portfolio was and continues to be very well diversified. And so the impact of those shares didn't really have as detrimental an impact on my portfolio as they could have. It was more of one of those companies I was really excited about, and the thesis just, was shown to not have a solid foundation over time. So you live and you learn, and you move on and you apply those lessons to future stock purchases. There's actually a question I wanted to hit that came in a couple days ago about ticker Boot for Boot Barn. This is not one we get a lot of questions about, so I thought this was an interesting one to take. I follow the e-commerce and retail space pretty closely. So Boot ticker is for Boot Barn Holdings. Interestingly, this is a stock that has had quite the run up. They traded at price to earnings of just around 19, market cap of about 3.3 billion. The stock's up more than 400% over the last 5 years and about 20% over the last year. They're trading down year to date. But for anyone that doesn't know this company, they are the largest lifestyle retail chain focused on Western and work-related footwear in the US. So they have over 400 stores in nearly all 50 states. They've said that they believe that they have 4 times as many stores as their nearest direct competitor that sells primarily Western and workwear. Their long-term goal is to grow their domestic store base to over 900 stores. This is a company that's been around a long time. They were founded in 1978. They've grown organically as well as through acquisitions through the years that have been really, strategic and really beneficial to their growth. Their stores, their strategy in terms of how they have their stores is they're typically freestanding, or they're located in strip mall centers. They're usually an average of around 11,000 selling square feet, and they feature a wide range of different brands and styles. And it's all, focused around Western themed items. So they sell, denim, Western shirts, cowboy hats, belts, belt buckles. They have a lot of their own in-house brands, as well as ones they've acquired through the years, like Durango and El Dorado. This is an interesting business in the sense that they have been very strategic in how they have expanded through the years, both through, internal business development as well as acquisitions. And they have managed to do a really good job of steadily growing revenue and profits, and are still continuing to do so, even in an environment where we've been seeing the appetite of the consumer to spend on discretionary purchases has definitely been in flux. Just to give an idea, they report their fiscal year a little bit differently. So the most recent report we have from them is at the end of January, and that was for the third quarter of the company's fiscal 2025. So their net sales increased about 17% year over year in their Q3. Same store sales were up about 9% year over year, and that was also driven by an 11% increase in e-commerce sales. They have a pretty robust omni-channel business. They also reported net income of about 75 million. Looking at the first 9 months of their fiscal 2025, their net sales grew about 14% year over year. Income from operations were about 13% of net sales. Net income in the first 9 months of their fiscal 2025 was about 143 million compared to 118 million a year ago. So a very nice bump there. And they have a really solid distribution of their sales between their brick and mortar retail stores and their e-commerce business, which has been very successful for them. They had about 153 million in cash on hand at the end of their most recent report, and zero drawn under their revolving credit facility, which is about 250 million. They are hoping to, by the time they reach the end of their fiscal 2025, have opened a total of 60 new stores. They're targeting net income of up to 182 million on total sales of about 1.9 billion for the 12-month period. So, I think this is one of those companies that for anyone who's interested in the retail space, this is could be an intriguing company to look at. I don't invest heavily in this space. One company I really like in the retail space that has exposure to brick and mortar is TJX Companies. Talked about that a lot last week. So this is obviously a business that, should consumer sentiment shift further downward and spending habits change, I think it's reasonable to expect that most any company with exposure to discretionary spending is going to be affected. But they've built a really solid financial foundation of strong revenue growth, really robust profitability, managing their debt really efficiently. And I think that's reflected in their financials. So interesting company. Those are, my thoughts on where it's at. I'm not currently an investor, but it's a fairly solid business within the retail space.
Follow up. Have you ever purchased anything at a Boot Barn store?
Well, I like Western style, but it's not really my style. So no, I haven't. But I do shop at TJX Companies. So
we didn't have any Boot Barns where I was. We were Le Bonville people up in northern New England. So unfortunately, I can't have any thoughts on Boot Barn. I want to hit a couple questions really quickly because they're going to be like 30-second answers. So apologies to the producer while they try to get the questions up on the display screen. And actually, why don't I do this while we're here? Since we are on YouTube Live, for those of you just joining, please go to slido.com and add the promo code Fool24, and you can get your questions in for us there at any time. Hopefully, we can answer your questions and get them in a timely manner. Just for anybody who hasn't participated here before. That's anytime you come to a YouTube Live, you can ask questions there. So rapid fire, really quick, because Vihan asked kids' educations, I only add ETFs and not risk into individual stocks. Can you please share the ETF tickers and game plan for kids with college? Because I use what's called a UTMA, which is a universal transfer. It's not a 401(b). It's not tied to any education plan or anything like that. So the tickers, it's really generic. I own like an S&P 500 index fund. I think it's through Vanguard. So that will be VOO. And then I do a real estate one. It's basically a split between those two. The reason that I do this is because my kids are very young. And maybe when they're older and we can have conversations about individual stocks, we'll start doing individual stocks. But I don't want to let my hubris of stock picking like ruin my kids' future money. So I just stick it in index funds until that actually happens. So yeah, that's kind of it. And as far as the kids' college, who knows? Maybe they don't even go to college, but then they'll just have some money anyways. And that's kind of why I decided to go with the UTMA, just in case. Like, life goes in a lot of different directions, and sometimes, not saying that that's personalized advice, like anybody should follow that, but who knows where life takes us, and sometimes just having that optionality is a nice thing, despite the downsides of a UTMA versus a 403(b) or a Coverdell plan or anything like that. Just a little bit more flexibility, despite the fact that there's less restrictions on what can happen with it when the kid turns 18, because it's basically their money, and then I don't have any opinions on that afterwards. The other question, Roy Tice asked, I hope I pronounced your name right. Apologies if I didn't. Guys, I love what you're doing, and thanks for all the great information. Tyler, any new thoughts on ticker TBBB, which is BBB Foods, the hard discount Mexican grocery chain? No, not really. No new thoughts. The last press release they put out was over 3 weeks ago. They're expected to report earnings within the next couple of weeks, I would assume. They typically don't give a lot of heads up on when it's going to happen. It's like, you get a press release, we're going to do it in 3 days, and then you just kind of get it. So yeah, not a lot of new information. Just a generic take on this one. BBB Foods is a hard discount grocer in Mexico. I really enjoy their story. I think their CEO kind of was an equity analyst who did hard discount grocers, said Mexico is the place where they need a market, and went down and basically started the company from scratch several years ago. It's like a decade of same store sale comps in the double digits, and has plans to go from 2,600 stores to 20,000 in the next several years. So I think there's a very strong growth opportunity despite the relatively low margins. I mean, it is groceries, but I think for a business that's relatively young, I think they're seemingly, so far, based on their financials and what I've seen so far, is they are extremely good operator. And I think that they have found traction in the market. And I'm very much looking forward to their earnings release and to see changes in store counts, as well as to see if we've been able to maintain the high same store sales comps. And I don't think there's going to be a lot of like tariff US stuff involved, because it's mostly like locally sourced products sold locally. Everything's done in pesos. There's not a lot of dollar foreign exchange, aside from the fact that the stock ticker and my per share earnings would be in dollar. What I would want to out of it eventually is in dollars, despite everything they do is in pesos. I mean, that's some foreign currency risk, but not actually in the operations of its business itself. So hope I answered that question really quickly and got enough information out for everybody.
So there was a question that came in a couple days ago from Lorenzo asking, what do you think of ticker MSTR, which is for MicroStrategy? I would like to have your insight on Mara, which is Mara Holdings too. Thank you for your valuable feedback. So these are two Bitcoin adjacent businesses, and I'm going to take a few minutes to talk about each of these and kind of my thoughts, because I do follow them a bit. These companies, for anyone who follows them, have seen shares get a nice bump, especially in the last few days with the announcement that the administration is planning to establish a crypto strategic reserve, which will include Bitcoin, and I think has boosted some investors' confidence in how the recognition of digital assets within the US financial system will look moving forward. For anyone who's not familiar with MicroStrategy, they actually rebranded to just Strategy as their name, I believe, in February of this year. They've been known for a long time for their business intelligence software, mobile app, and cloud services. They were founded in the late 80s. Their software business has historically been incredibly slow growing. They do have a business intelligence segment where they analyze data to help businesses make decisions. They do develop some apps for mobile devices, and they have different cloud-based services. But their Bitcoin business is the most significant aspect of their growth, and probably what most investors nowadays pay attention to MicroStrategy for. So essentially what MicroStrategy does is they make money by buying Bitcoin using debt and equity, and then selling stock to finance these purchases. And the stock price of MicroStrategy has increased in recent years, primarily due to their investments in Bitcoin. So they'll take on debt to buy Bitcoin. They can issue convertible debt, which gives buyers the option to convert the debt to MicroStrategy shares at a certain price. Then they issue equity to buy Bitcoin, and then they sell stock to finance their Bitcoin purchases. This is a company that has captured about 30% of the U.S. Convertible bond market so far this year. To give an idea, their strategy as it relates to Bitcoin, which is again the biggest, I think, aspect of this business that anyone's paying attention to right now. It's highly risky, very speculative, because their success as a business depends on the long-term success of Bitcoin. Currently, strategy, formerly known as MicroStrategy, holds about 500,000 Bitcoins worth over 40 billion. So, they primarily had their core operations as this business-to-business enterprise software provider up until 2020. Then that changed. Revenue growth was really slow. They had a lot of cash on hand. And so the now former CEO decided to allocate about 250 million of MicroStrategy's funds to Bitcoin. And that was really the first time a publicly traded company had ever taken this move. Obviously, that was a very successful move for the company, at least in the last few years. They acquired, at this point now, as I mentioned, about 500,000 Bitcoin for a price on average of about 65,000 per Bitcoin. Now, the thing is, they're very unlikely to actually turn around and sell off their Bitcoin holdings, especially because that software business of theirs, continues to be pretty weak. Just to give a concept of how they're doing, financially in 2024, MicroStrategy, they generated total revenue of about 464 million. And that was down about 7% from 1 year ago. As I mentioned, their software business, which is what they were known for until about 5 years ago, is growing very, very slowly. Their debt has skyrocketed in the last few years. As I mentioned, the way they use that to leverage their Bitcoin purchases, they have net debt of about 7 billion as of last count. They do have about 6 billion in convertible notes at their disposal that they're planning to use to raise funds for Bitcoin purchases in the future. So they could have as much as about 7 billion to purchase more Bitcoin this year and beyond. The biggest risk for this company is obviously if the price of Bitcoin plunges for a significant period of time, is MicroStrategy's entire business model, as they have reshaped it over the last 5 years, is left at risk. If Bitcoin prices are strong and that supports more favorable loan conditions, then MicroStrategy's strategy could pay off. Very, very risky. This is not one that I currently hold. Mara Holdings, the other company that Lorenzo mentioned, is similar. But what they do is they're a digital asset technology company that mines cryptocurrencies, primarily Bitcoin. So they own and operate data centers. They sell software and technology to other companies that are specifically in the Bitcoin ecosystem. So their core business at Mara Holdings is to use specialized computers to solve complex mathematical problems to mine new Bitcoin on the blockchain. But of course, in so doing, as Bitcoin's price fluctuates, so does their revenue and profitability. They also generate revenue by providing data center services to other companies. They have a massive mining infrastructure. Some companies are also, exploring ways to optimize energy usage by capturing excess energy from renewable sources to power their mining operations. This is something that Mara has been exploring. they actually have seen a significant rate of growth in recent quarters. Again, although they're reliant on Bitcoin's price in a different way than MicroStrategy was, as I explained, in an inflationary environment, there's a lot of risks to Bitcoin's price. In their most recent financials, which they reported for 2024, they had a really bumpy spring last year, but even so, they still reported record high revenue, net income, and adjusted EBITDA for 2024. Their Q4 revenues were up 37% year over year. They are actually profitable under GAAP. They reported net income of about 248% year over year in Q4. These are businesses that I think are, highly speculative in nature. They're heavily tied to the price of Bitcoin. As I mentioned, MicroStrategy uses, debt to fund Bitcoin purchases, and that has been basically the biggest driver of growth for the company. Mara's strategy is about mining Bitcoin and then running its network of data centers as well, which helps to, provide the power needed to have these massive computations. I think for anyone that's interested in this space, this could be a potentially kind of fascinating way to capitalize on the growth of these digital assets. But for me, as someone that has historically stayed away from Bitcoin anyway, I would not personally put my money into this. I think for individuals and investors who are interested in the growth of digital assets, this could be a somewhat a different way to invest in the potential of this space than directly holding a cryptocurrency. There's obviously, more optionality in terms of investing here. So those are some things to consider. Very risky, very speculative. If I was to invest in this personally, I would not make it a significant part of my portfolio. I think you're seeing a little bit of additional optimism around these stocks right now, particularly given the changing stance of the U.S. administration regarding the use of digital assets. So some things to watch and pay attention to if you're looking at these companies moving forward.
I have to confess, Bitcoin and crypto is far too smart for me. I'm too much of an idiot when it comes to these things to make any sort of comprehensive or even coherent statement about it. So I'll Charlie Munger with that one and say I have nothing to add. But I do want to hit one question here. Let's see. About 2 days ago, Dave J asked a question way more in my wheelhouse, because we're going to talk oil and gas, because that is definitely a strong flip from going from crypto. Dave J asked 2 days ago, all this, I'm going to shape the question a little bit based on Dave's comment/question. It says, all this forced uncertainty is focused to Europe. Markets there have been soaring and the EU just cut rates. Anyone there looking to Total, which is Total Energies, ticker is TTE, or Equinor, ticker is EQNR. Well, lucky you, Dave J, because these are actually the two oil and gas companies I actually own. So I can give a little bit of thoughts on these. I don't want to focus much on the macro kind of commentary here, on the focus on Europe, market soaring, and European central bank cutting rate. I just want to focus on these companies in particular, because, like I said, these are the two companies in the oil and gas space. The two integrated oil and gas companies that I currently own versus the ExxonMobil Chevrons of the world, because these are more or less the same thing. Total Energies is the French integrated oil and gas giant, upstream, downstream, refining chemicals, as well as a renewable energy platform. And Equinor, same thing, production, not much refining, much more like movement product. Their big name of the game is natural gas moving in Europe, because they're one of the largest suppliers. Even before Russian oil and gas, Russian gas was kind of restricted in Europe. Even before that, Equinor was and Norway in particular was one of the largest producers. So it's kind of been their bread and butter for a long time. But the reason I like both of these businesses, aside from any of the macro stuff, is number one, they have been very good over the past 10 years of managing what has been a tumultuous time in the oil and gas industry. If you look at some of the other European majors like Shell and BP, they've made these hard strategic pivots, like, oh, we're going to decline our oil and gas, we're going to let our oil and gas portfolios kind of naturally decline. Not going to invest much into it. We're going to spend a lot in renewable resources. And, it wasn't just that, it was just, I think a couple of weeks ago, both companies, Shell and BP, basically ripped up those plans, said, nope, we're going back into oil and gas because it's far too profitable and we kind of stink at renewable energy development. So both Total Energies and Equinor have been competent in the sense of like they're expanding their oil and gas production, Total Energies in particular in liquefied natural gas export. That's been their big center of production growth. And for Equinor, well, they've got basically rights, they get first in line for anything on the Norwegian continental shelf, which is one of the lowest cost production zones in the world. And so it's a very low cost, very reliable long-term source of oil and gas that has, it basically has a front row seat to delivering to the European market. So a very lucrative market relative to, oil and gas there is a little bit more expensive, especially on the gas side compared to North America. So higher margin business there. So good production, good returns on these businesses, both of them in the double digits on their oil and gas businesses, while spending robustly in these to grow them, with the acknowledgement that, liquefied natural gas in Europe are both going to be long-term, multi-decade investments that are going to be lucrative, and we're not going to see a long decline. Oil production, they're keeping steady, maybe some modest declines here and there, but kind of picking their spots, being like, look, we're going to invest here provided we find excellent reserves. Total has spent a lot on the off coast of Angola, Namibia, as well as they just had a large find off of the coast of Suriname. So good portfolio there. Like I said, Equinor, Norwegian continental shelf has been fantastic for them. But the other component I like about them as well is these are actually only two integrated oil and gas companies that have shown to be remotely competent at actually investing in renewable energy versus the rest of them. Both Equinor and Total Energies have been able to invest in renewable energy and get returns on capital in the double-digit rates, so 10%, 12% or better. You cannot find another oil and gas company in this industry that has broken 5% on a return on capital. They have stunk. No other way of saying about it that at deploying renewable energy. ExxonMobil tried with algal biofuels. That hasn't really worked out. Now they're going to drill for lithium in Arkansas. Chevron, bet the farm on carbon capture and as well as renewable fuels. Hasn't really worked out for them well either. So, and then Shell and BP have been an absolute hot mess. Just to be frank. So these are, I think, from an operation standpoint and a long-term strategic standpoint, I think that these are the two better operators in this industry. And at the same time, they still trade for much more favorable valuations than what you see for for the American majors. Right now, Total Energies has a forward dividend yield of about 5.6%, trades for 9 times earnings. Equinor has a 7% dividend yield, trades for 7 times earnings just in 2024. And that's even from a down year in terms of earnings compared to 2023. So I think these are much cheaper, well-operated businesses that have a clear plan for renewable energy. I would, if I was going to invest in, I'm kind of talking my book here because, like I said, I own these ones. And if I were to add to positions right now in the oil and gas space, especially in the integrated majors, these are the two that I would be picking, probably Equinor more so than Total at this current point, mostly just because of valuation. But overall, these are the ones I would want to be in.
There was a question that came in from Vihan about 17 minutes ago. Thoughts on MTY Food Group at its current valuations? So I wanted to kind of offer my thoughts there. For anyone that's not familiar, this is a Canadian franchisor and operator of over 70 different brands, both in Canada as well as in the US. They have been a serial acquirer through the years, as well as a really faithful dividend payer. But essentially, they own a lot of brands brands focused on different types of cuisines: Asian, Greek, Middle Eastern, Italian. They operate their restaurants in Canada, the US, as well as some international locations. They're known for some of their brands like Papa Murphy's, Thai Express, Pinkberry, Country Style. Those are just a handful of the dozens of brands that they own and operate. And they have faced some challenges in the last few years. They actually had a pretty rare net loss in one of their recent financial reports related to impairment charges stemming from their Papa Murphy's brand, as well as foreign exchange losses, which led to a big earnings per share miss from what analysts had been projecting. So they recorded a roughly $65 million impairment charge on goodwill related to the Papa Murphy's brand, just stemming from lower than expected performance in that particular division. They've been facing some challenges in the US segment of their business. Macro factors have obviously been one notable area there. And then they also recently reported about a $26 million foreign exchange loss on intercompany loans that further impacted their profitability. Over the long term, though, and over the course of this company's history, this has been a business that has had a really aggressive and also very successful acquisition strategy that has contributed to their growth through the years. They, as I mentioned, are mostly a franchisor, so they make a lot of their money from franchise fees. They have dealt with some closures from franchisees in recent quarters that has impacted their growth rate and just growing competition. In terms of their actual valuation, and just for anyone that is curious about this company, MTY Food Group, they trade on the over-the-counter market at ticker MTYFF. So that's MTY Food Group. Their trailing PE is about 44, which is a bit lofty in my estimation. Their price to sales, however, is less than 1. So they're currently trading now for about $30 a share. So I mentioned some of the headwinds that the company is facing. So that impacted the top line. Growth slowed a bit in their most recent fiscal year compared to the year ago one. However, they are still, successfully growing their free cash flow from operations. As I mentioned, they had a pretty rare for the company net loss to close out 2024, but they were still profitable for the full year. So they reported revenue of about $1.2 billion in 2024 and net income of about $24 million. And a huge part of that, again, they dealt with a net loss of about $55 million in Q4. So that impacted their profitability. Most of that was related to that impairment charge related to the Papa Murphy's division. But they reported cash flow from operations of about $205 million, free cash flow of about $138 million. They continue to faithfully pay out and increase their dividend, which is something that they've been known for through the years. They have thousands of locations in North America as well as some internationally. And again, they operate most of those through their franchise model. So that's given them a pretty asset light profile. And they have generated positive free cash flow every single year for, I think, 24 or 25 years at this point and counting. And so the stock has been historically a very significant performer despite its recent struggles. They've also had a pretty impressive return on invested capital of in the double digits, which is again impressive for a business that operates in the industry it does. So I think it's trading at a pretty depressed valuation to where it's been historically. As I mentioned, their portfolio of brands, their really impressive history of growing free cash flow, and just their strategy of being historically a serial acquirer has been really key to their growth over the long run. This isn't a business that I don't think anyone would invest in looking for significantly high growth rates. This is not a high margin business, but when it comes to a resilient business, one that has been a steady income provider for dividend investors and a really, really solid generator of free cash flow, those are perhaps some reasons, to look at the stock while it's currently trading down.
So we're a few minutes past the top of the hour, but that was by design because we're going to take a quick break here from doing live taping, and for the next hour we're going to be broadcasting a pre-taped interview where our chief investment officer at the Motley Fool, Andy Cross, had an interview with Goosehead Insurance chief financial officer Mark Jones. So if you're tuning in, we're going to do a quick pause while we switch over from live broadcasting to the recording. So please stick around. And when that recording is over, we'll be going back to live taping. So stick with us. And just because we're switching off, don't change the channel. So Rachel, thanks for joining us for this hour. And for all of you, thanks, and Fool on. We'll see you next time.
Fools, welcome to another Motley Fool conversation. I'm Andy Cross, joined around the table here with Tom Gardner, our CEO and co-founder of the Motley Fool, Matt Frankel, a Motley Fool contributor, and we're super excited to have Mark Jones here, the CFO, Chief Financial Officer of Goosehead Holdings. Mark, welcome to the Motley Fool, and thank you for joining us.
Thanks for having me.
This is my favorite way to start the interview. So far, you've been a great stock for us. Will that continue?
I hope so. I'm probably not allowed to comment on that.
Exactly. That's the wrong first question, but it's foolish. Back to Andy.
It is very foolish because we're investors. We started many years ago. Tom and David started as investors, studying great companies and trying to find the best companies we can invest in for individual investors around the world. Mark, and we're excited to talk a little bit more about Goosehead here with Matt and with Tom and with many of our members. So thank you for joining us. Matt, why don't you take it away and start us off with a couple questions?
Yeah, I'll start off with an easy one. You're different than other insurance companies. You don't write insurance policies yourselves. You're an agency. Can you just kind of briefly describe how your business works? I know you're a franchise model, so kind of give us some color about that.
Sure. Yeah. So we are, as you mentioned, a personal lines insurance agency. So that's a little bit different than anything else you would see in the space. Most other public companies that are agencies are mainly focused on commercial lines and don't really have a big personal lines operation or aren't really interested in growing a personal lines operation. We're very much so focused on personal lines. I think it's an area of the market that has been really underserved from a technology investment, from a people investment standpoint. We distribute through really two different types of agents. So we started franchising our front office business, the sales office of side of this, in 2012. Today, we've got a little over around 1,100 franchises out in the field, encompassing about 2,200 producers out there on the franchise side. And we got about 417 corporate agents that are W-2 agents. And all of their jobs are to go make relationships with loan officers or realtors and part of the home closing transaction, get leads sent to them, and then they can sell the home insurance associated with that transaction and cross-sell the other lines of business. It allows for clients at the point of need and urgency to interact with a knowledgeable agent in kind of a tech-first organization that allows them to act with a lot of speed and urgency. But we've also, over time, built out a really strong carrier portfolio. So we distribute product through about 280 different insurance underwriters. That's been growing over the last few years as there's been some constriction in the market of underwriters. But that allows us to serve really every market, everything down from your $150,000 home all the way up to high net worth and from coast to coast. So it's a pretty differentiated model.
And Mark, it's almost all on the. I mean, the big part of it is tied to home insurance. It's there's not life. It's really on the personal lines, and really, I mean, home is the big need and the big driver of your business, right?
That's right. We lead with the homeowner's transaction. So if you're thinking about when somebody needs to buy a home insurance policy, it's typically when they're closing on a home. So there's not an incumbent policy you need to try and beat. They have to make a decision. That's an easy point for us to get involved in the transaction and make it really seamless for the client, but also make it really seamless for the loan officer. So if you think about why do they want to work with Goosehead, it's because we can provide speed and choice like nobody else in the market to make sure that they don't lose any home closing deals because of insurance. And then we try to round out the client and cross-sell the other lines of business. So auto, umbrella, flood, a little bit of life, but homeowners is really our bread and butter.
Yes, you just mentioned homeowners is really your bread and butter. In your latest investor deck, you specifically call out home insurance several times as being a big growth opportunity. Do you see home insurance as your biggest long-tailed growth opportunity in Goosehead?
I think so, because that's the way we connect with the best type of client. So if you think about somebody that's buying a renter's policy, they probably don't have a super big asset base, and the premium is not super big on a renter's policy. So our commission might be $5 on a renter's policy. A homeowner's client probably has a car. They may have more than one car. They might need a jewelry policy. They likely need a flood policy, which means they also probably need an umbrella policy. So there's a lot more opportunity to capture the other lines of business if you lead with the homeowners. Whereas it's not true the inverse. If you're just getting leads off of an auto dealership, not necessarily all of those clients are homeowners. They may be renters, they may be living with their parents and somebody else has the insurance. So leading with the home allows us to access a differentiated client that helps our carrier partners as well get a better underwriting loss ratio performance.
And Mark, is the franchise side and the in-house side, as I'll call it, working with the loan officers, when you think about balancing between the growth profile and the resources that you're allocating across the company, how are the growth profiles in both those businesses looking today? How are they operating?
Yeah, so on the franchise side of the business, that's where probably the biggest growth opportunity is over the near to medium term. We've got about 2,200 agents, like I said. Today, we expect to continue to expand that throughout 2025 and into the future. We're less than 1% of the personal lines market share in the United States. So the total addressable market is really, really big. There's a lot of opportunity for us to continue to grow. And we're pretty heavily dense in Texas, more so on the corporate side than we are on the franchise side. But there's a lot of geographies where we are really underrepresented from an agent force perspective that produces a lot of opportunity for us.
And is it heavily on the franchise side to go and open new franchises, scout new franchises, find the right partners, which is a big part of what you're trying to do? From the regulatory perspective, is it differ vastly from state to state? How does that all work? 'Cause I know you work with national carriers as well as lots of different kinds of carriers.
Yeah, it is. So in personal lines insurance is regulated at the state level. So it's 50 different regulators, which creates a lot of complexity for anybody trying to scale on a national basis. That's why we feel like we've got a pretty defensible position in the marketplace, because there's not really a good comparison of somebody that is targeting personal lines only across the entire US, because it's really complicated. You have to deal with 50 different DOIs and build a carrier portfolio that works in Florida, but also works in California and also works in New York. And that might be a lot of different types of carriers. It's not all going to be Progressive Traveler Safeco. You're going to need some Cajun underwriters in Louisiana, some of those. And if you don't have the product team that can go develop those relationships and the agent force that can provide high quality clients to the carriers, you're not going to be able to build those relationships.
How has Goosehead had so much success with the franchise model? Like, what is the process for becoming a Goosehead franchisee? And what you mentioned, you have, I think it was 1,100 franchisees specifically. Like, how have you been so successful with that business model more so than other insurers?
So when we set out franchising, what we decided was the back office of this company scales really, really well. The service function, the finance and accounting team, the quality control team that's reviewing all the policies, all of that scales super well. And really the limiting growth factor was our ability to go recruit new college age kids and put them into one of our corporate offices, but then importantly have the management bandwidth to absorb all of them. We kind of call that term absorptive capacity. Franchising the operation and having it all work on one centralized back office, a fully integrated model, allows us to grow the front side of the business really, really rapidly. So we've had very rapid growth for the last 12 years since we started franchising in 2012. So I guess it's 13 years now. And it's a really compelling value proposition. So if you are an agent in a captive model, somebody that can only sell one product, the choice platform naturally makes a lot of sense to you, because if a client calls you and says, I need to reduce my premium, it's getting too expensive, the only option you have is to cut coverage. Try and search for some other discounts out there, but those are pretty hard to find. If you have a choice platform, you say, okay, well, let me shop you with this other carrier and see if there's somebody that's willing to take the risk at a lower price. And consumers more and more today actually demand choice. If you look at some of the industry data, captives have been losing market share to both independents and directs for the last decade. I think that pace is only going to continue. And what's interesting is independent agents haven't lost any share to the direct side of the business, which you would think maybe that would start to happen with a younger generation. Don't necessarily always want to talk to an agent, but because we target specifically the homeowner's transaction as our lead go-to-market strategy, typically people don't want to try and underwrite that themselves. That's their largest asset. You want to talk to a licensed professional who understands the product nuance and not necessarily try and buy it direct. There's also not really a lot of direct home insurance product out there. But from a franchise value proposition standpoint, you get access to our carrier network. We help onboard you to make sure you've got all the training and technology tools that, from our perspective, are better than anything else that's out there in the industry. We've built what we call our referral partner search tool, which that allows you to, via a database that we've compiled, see every single home closing transaction in the country, which means you know who's the loan officer and who's the realtor on both sides of the transaction. And you can be really specific in your targeting or in your marketing efforts to make sure you're going after the highest value potential partners first. So that's a really differentiated piece of technology. And then from a comparative rater standpoint, once you've got a client on the hook, being able to quote them across multiple different carriers in a seamless fashion, we built our own proprietary comparative rater that allows agents to quote much more quickly than what else is in the market. And then you layer on top of that, the next iteration is a platform we call Quote to Issue. And that allows you to, all within the Goosehead ecosystem, bind the policy without having to bridge to the carrier site. Now, that's not live for every carrier in every state, but we've made material progress on that in the last couple of years. That, again, just speeds up the time that an agent can close on a policy and then allows them to reinvest that time back into marketing efforts or serving their existing clients. And then from a franchise perspective, one of the biggest challenges in the industry is as your book grows, if you're not with Goosehead, you naturally hit a growth asymptote because your book gets so big, you spend all your time servicing and none of your time selling. So one of the biggest differentiators for us is we've separated the sales and service function, which means after you've initially closed the policy, yeah, you want to maintain that relationship with the client. But if they need to, say, add a car to their policy, it goes to the service team to handle that at speed. And we've got over 700 licensed US-based agents that make sure your book of business stays in force for as long as possible. Because I think what's obvious is in this industry, it's all the money is in the renewals, right? The first year of the policy, yeah, you're making some money, but you want to keep that client on your book for as long as possible. And our service team allows us to do that, I think, better than pretty much anybody in the industry.
If I'm correct, the company was founded in 2003. I'd love to hear what you see, what you think as a leadership team and as a board are the major strategic decisions you've made over these 20 years, and what is one that you're facing now as you look ahead?
Sure. So the first most major strategic decision was separating sales and service. So it hasn't always been that way. When we started the business, the thinking in the industry was every time you talk to a client, it's an opportunity to build a relationship, to cross all of the lines of business, to deepen that. But what we found over time was our best sales agents did the worst job servicing because it was just kind of fundamentally a different personality, somebody that's hungry for the next sale. Whereas the service agent needs to have kind of unlimited patience and be able to solve whatever problem that the client has. So separating the sales and service functions was the first big epiphany of the business. I think that's been a really successful one. The next biggest piece was in 2012, the franchising. So being able to grow the front office a lot more quickly and rapidly expand across the United States. And then in 2018, we launched a product called the Digital Agent, which is on our Goosehead website. You can go and basically fill out a form and get a quote back that is, in many instances, a quote that is very close to the actual bindable number. That will change as you go through from rate call 1 to rate call 3, but it is very close to what the actuals will be. That doesn't actually exist anywhere else in the industry to our knowledge. There's plenty of websites that tell you they're comparison shopping, but really what they're doing is stealing or selling your data. I shouldn't say stealing, but selling your data to all the other insurance carriers. And so you're going to get a call within 5 minutes from 5 different agents. And then every year you're going to get another call because they know your policy is coming up for renewal. Our digital agent platform doesn't sell you information ever. It just gets it to a Goosehead agent who can act on that at speed. Those are probably the 3 biggest ones that we've done over the last 20 years. In the future, as we get more into the partnership channel, that's an area where we haven't really expanded the business dramatically absent the last couple of years. So in 2023, we launched a partnership with Vivint Smart Homes. And they do alarm installations, and naturally that's really adjacent to the insurance product because typically you can get a discount on your homeowner's insurance if you have an alarm. And so they'll send us leads for alarm installs. Or for home insurance, we send them leads for alarm installs. It's a natural symbiotic relationship, but we're looking to expand that channel pretty rapidly. And one of the interesting developments in the industry is homeowners insurance typically has not been that big of a topic of conversation for mortgage companies. It's just been something that has to get done, not usually a roadblock. What we're seeing now is mortgage servicers are experiencing slight upticks in default rates on their book because many times the insurance and taxes are the same amount as the principal and interest on the mortgage in your escrow. So it's become a really important topic of discussion. And so what we're doing to try and solve that problem for mortgage servicers is there's a couple options that they have. They can embed a Goosehead franchise into their existing business. And so if you think about a servicer that's got 70,000 clients on their book, okay, they know all the information about the home, they know all the information about the client, and they know the existing insurance information. So that allows them to be super targeted on when they can actually save somebody money and be proactive about it. That's an avenue that we're attacking today. And then obviously AI is the topic of conversation, I think, in every business. And so we're looking at ways that we can revolutionize the service force, make sure we're optimized from a client experience perspective, but also a cost to serve perspective. And then how can we point those tools at sales agents to make sure we're matching clients with carrier underwriting appetite as best as possible so we can drive profitability for the carrier partners? Because obviously none of this works if we don't write profitable business for the underwriters. And so that's a big objective, and I think one we can use AI to do.
One of the things that we love about founder run companies or companies that are public with the founders very involved all the way through is that rarely I find were they acquisitive. They generally decided to grow their business organically. Maybe that was because they like to have their equity stake continue. They like to have more. They were more interested in organic growth, maybe internal promotions, et cetera. But when you look at this category and how fragmented it is, I do wonder, do you think there's an acquisitive approach for Goosehead going forward, or do you feel that it's been the right decision to be organic in your orientation for growth?
I think it's certainly been the right decision so far to be organic in our orientation. I mean, if you look at our growth rates and our profitability, most things that would be available for us to buy would be dilutive to one or both of those things. On a go-forward basis, that's generally how we still feel about it. Most M&A ends up being a shiny object, a distraction for the management team, and I think the stat is something like 50% of those deals don't end up really working out. I look at a lot of things. A lot of stuff comes across my desk of potential acquisition targets. So far, there hasn't been anything that I thought was a compelling either valuation or adjacency for the business. It's not a never will happen, but it would really have to be a sweet spot for that to happen.
So I do have a follow-up on Tom's acquisition versus organic question. But before I get to that, I want to ask kind of a more fun question that's been on my mind since I first heard of the business. I said when I first wrote about Goosehead, I think 3 or 4 years ago, that it has the least boring name of any insurance company I've ever heard of. I mean, think like Geico, government employees insurance company, boring. But Goosehead, where did that name come from? Where did it start?
Yeah, so I come from a really big family. My parents are the founders. I think that may be obvious. I have the same name as the founder. We have a big family. I'm the youngest of 6. So my sister, the oldest grandchild in the family's name is Lucy. My dad is big on nicknames. Lucy, Goosey, Goosehead. And so she's 17 now. So when the name changed to Goosehead, I think that was in 2011, 2012. She was pretty young. She thinks that the company is all hers. It's fine. We'll let her think that. It's great for a 17-year-old.
Are you the what? How many family members are involved in the business?
I'm the only one still involved in the business. Everybody at one point or another has worked here.
So I'll ask my less fun follow-up now. This is a direct quote from one of your investor decks. It says, your goal is to be the, quote, largest personal lines distributor in the U.S. in our founder's lifetime. Now, there are some direct insurers that have much larger market shares, like 10 to 20x where you guys are. And if the preferred path is not to be acquisitive, is to grow organically, what's the path to get there? And in your founder's lifetime, as you put it?
Yeah, the path to get there is rapidly expand your headcount and continue to drive productivity as aggressively as possible. Our investor deck would tell you that our agents are kind of multiples of industry best practice. That doesn't mean that they're where we really want them to be, though. I think the ceiling on productivity is much higher than where we are today. But also the TAM, if you think about TAM of producers, the TAM of producers is really, really massive. There's thousands and thousands of insurance agents in the country. So there's a long runway for us to continue to grow, and we got to do it really, really rapidly. There's two variables to that goal, right? It's how long does the founder live and how fast do we grow? Now, I'm trying to extend the founder's life for as long as possible. Obviously, he's my dad. I'm also trying to push the growth rate for as fast as possible in a profitably responsible way.
Hopefully they go hand in hand. You can grow very rapidly and your father can live for many, many years.
Ideally.
Yeah. Mark, I'm curious on your marketing strategy. How do you think about, is it primarily really working with the lenders and the firms? How do you grow? Do you have an intent to really grow the brand of Goosehead to more consumers? What are your thoughts there about trying to expand, as you talk about the TAM with the agents, but just maybe just growing awareness?
Yeah, so we intentionally do not have a very big advertising budget because I don't think it's super effective. The customer acquisition cost of buying those eyeballs is super, super high. And if you just look at an example of somebody like Progressive, they spend a lot of money on advertising. I think they do it very well, but they also distribute through independent agents because there's a difference in the customer acquisition cost. It's really expensive to buy the eyeballs versus distributing through an independent agent. For us, it doesn't really matter if everybody in the world knows who Goosehead is. What matters is that the mortgage officer that's closing on the home in Austin, Texas, knows who Goosehead is. And the way you build those relationships is on a one-to-one basis, because those mortgage officers want to work with somebody in their community who understands the product nuance that's happening in their local region. It's very different to operate in Florida than it is in Central Texas, than it is in California. And so you need to be on the ground in those markets. So we go out, it's also very inexpensive, but we go out and we meet those people physically, explain our value proposition. And then when they send a lead over and we can execute it at speed and deliver on our value prop, there's not really a need to go elsewhere. And the RESPA regulations would prevent you from really sharing economics because you're not really allowed to. So there's not really this quid pro quo there. It's we just want to help each other and our businesses grow. I think it's a really inexpensive way to attack marketing. Now, we're still going to do scrappy marketing type activities. Your search engine optimization, try to be present on social media, make sure our marketing campaigns are as, pretty and informative as possible. But we're not going to have a Super Bowl ad. You're not going to see a Goosehead Stadium. We're not going to be on a golf tournament.
Mark, I want to talk a little bit about the market the market you're facing right now. You talked a little bit about this recently. I think it was really, really interesting about the complexity of the insurance market, especially as inflation has kind of really ebbed and flowed. And I think that speaks to maybe some of the strength. You talk about the last couple of years as inflation has been high, then it fell, and all in between, working with the agents, helping them be able to work with their end clients and recruit more end clients and drive more business because of the market complexity that insurance has become.
Yeah, premium inflation specifically over the last several years has been really, really high. I mean, pricing has taken off really since kind of the middle of 2022 pretty aggressively, more than what we've seen in our company's history. That has led to a couple of things. One, when premium is running really hot, that typically means that carriers are either pulling out of an industry or an area or trying to reduce growth as much as possible. That's a challenge if you don't have a really robust product offering. And one specific example I would give you is California. So there was plenty of news in California and before these wildfires about, State Farm pulling out, USAA pulling out, a bunch of other underwriters completely stopping new business in California. Whereas we pretty aggressively onboarded product onto our platform in California. And it's not always the admitted product, it's excess and surplus lines, which from a regulation perspective is a little bit different, but we've been intentional about trying to provide our agents with the most access possible. What that's led to in California is really, really strong same store sales growth for multiple years in a row because our agents are the ones that are best armed in that market in a pretty constrained product market. And you can contrast that to somewhere like Texas, where it's been a pretty constricted product market for now about a year and a half, as carriers try to deal with these hailstorms in Texas, severe convective storms, that there's not really reinsurance capacity for. That's a big challenge. And so what we've been trying to do is make sure our existing clients know when you get a big price increase, you need to call Goosehead first, and we can shop the market and make sure that you're covered appropriately. So you don't go to a different agent who's going to undercut your coverage and say, look, I saved you some money, but Aaron, I've actually covered appropriately. We want to cover you appropriately. And if we're not the best option for you, I want you to go find the best option. And then you'll come back when the market shakes out itself, because it is a supply and demand issue. And it's been a tough slog for the last couple of years for clients and for agents alike. And I think we've combated that storm pretty aggressively. Yeah.
Yeah. So, I don't want to put words in the other two people's mouths on the call, but I have to imagine that one of the things that attracted Tom and Andy to Goosehead is the economics of the business. It's a very high margin business. I want to say in your last quarter, it was something like a 40% adjusted EBITDA margin, very attractive economics. Can you kind of walk us through, because it's important for investors to understand how the business makes money. If you're not a regular an insurance company like we all kind of know, is it commissions or there's some sort of franchise fees? Can you kind of walk us through that?
Yeah. So we typically break down our revenue into three buckets. Core revenue, which is the revenue we get from selling insurance policies. So you sell a policy that's $1,000 of premium at a 15% commission rate, you get $150 in commission. We just do that a lot of times over and over and over again. On the corporate side of the business, we recognize 100% of that as revenue. On the franchise side of the business, just our royalty is revenue. So we would get 20% of the first term of the policy. And then each time it renews, we get 50% of that. That's what really drives the entire business, is the core revenue. Commissions coming off of insurance policies that we sell. So we place a policy with Progressive, we pay Progressive the premium, Progressive plays us a commission, we pay the agents. Then we have cost recovery revenue. That's really franchise fees that new franchisees pay. And that's really just a mechanism to cover our costs to find, onboard, license, and get them active. It's not necessarily a way we're trying to make money. And then there's ancillary revenues, which is contingent commissions. That's basically bonuses that an underwriter pays agents for delivering really profitable business for them. That's really the three buckets of revenue. And then on the expense side, headcount is our biggest expense. And the majority of that is on the service team to maintain the existing book of business, because the renewal book is significantly more profitable than the new business book. A policy in term 8 is a lot more profitable than a policy in term 1, and it typically just requires less work. And then on the technology side, we're placing a lot of resources into our tech function to optimize tools for agents, but importantly, to help automate and reduce complexity in the service side of the business. That has allowed us, I think, to grow our margin profile really nicely over the last several years, and we expect to continue that in the future.
Mark, maybe a quick one. You mentioned the E&S market. Is that going to be a larger part of your business, or will it be still predominantly in the admitted market?
Our business has picked up on the E&S side over the last couple of years, really more on the coast. So coast in California and the Gulf Coast, but we have a pretty heavy presence there, specifically Houston and the Gulf Coast of Florida. I don't expect that's going to be a long-term thing. It's still a very small percentage of our total new business, but it has grown over the last couple of years. I would expect as the admitted carriers get more pricing through their book of business, they come back in and less of it goes to E&S.
And you had mentioned just about the investments in technology, and we talked about the more agents you can have that are more productive and profitable, the better for everybody. It is this interesting balance as you think of as technology starts to come into helping so many companies be more efficient. Is it a case where it's one or the other, where you don't have to bring on as many agents because they're more efficient through AI, or is it a case where it's really going to be an accelerator as you add on more franchisees, more agents to be able to utilize your technology stack to be able to be more productive?
Yeah, I think it's both. I think our existing agents can get a lot more productive utilizing more technology enhancements, some AI tools that we're working on today. And I also think it unlocks the client pool that we just don't really have access to today. The online shopper who may be the right profile of client that we want, but there's not a marketplace for them. I think if we can provide the right tools in the market, we can capture a significant amount of market share in a really rapid fashion. But we still very much so believe in the role of the independent agent in insurance distribution. I think the vast majority of clients, especially on the home side, want to talk to an agent and understand what they're getting into. And we are trying to build the technology that can be as simple as possible for clients to understand as they're clicking through and try and digest all the complex financial implications of a home insurance policy. But really, for the most part, I believe the independent agent still has a really big role in this industry.
Mark, we're going to try something here, and if it doesn't work, well, then we will not spend much time on it. I don't know if you're going to be able to see this on your monitor, but
I see it.
Okay, I'll first describe what it is. This is our Moneyball database. It's an AI-powered database that scores public companies. It's scored actually in this database 3,400, but we've also scored over 2,500 microcap companies in a separate database, because getting all the data sourced for very, very small companies is hard and complex. So here we are. You're in the larger database with your market cap north. Well, what is Goosehead's market cap right now?
Depends on the day, about 4.5 billion.
Yeah, about 4.5. That's what I thought. So here we are in the Moneyball database. Now what I'm going to do is I'm going to type in Goosehead, and and so we can look at some of these scores, and you can tell me if you think if you'd like to object to any of them. So I'll walk you through them. We have Goosehead, ticker symbol GSHD, insurance. Rounta is a financial formula, return on unlevered net tangible assets. It's actually purported to be a factor that Warren Buffett, he's certainly written about it in a shareholder letter years ago. Essentially, what sort of, operating cash flow do they draw to their physical asset base? And, general view that above 20 to 25% is a good target. Okay, so Goosehead is 54%. Our financial prompt, this is an AI-powered prompt. Each of these now is a combination of AI engineering and investing expertise internally, where we pair those two things together, grab all the data, systematically have built numerous prompts, collaboratively built those prompts, and ended up with scores. Okay, so here we go. The financial score for Goosehead is 83. The product score is 75. Leader score is 75. Tech score is 51. The GARP, growth at a reasonable price, some measurement evaluation, is a 75. AI is a 35. And your overall super score is a 70. Now, I do have to share this with you before you respond, if you'd like to any of these scores and object to any of them or enlighten us on any, that this is up against 2,400 different companies. So, NVIDIA is off the charts with its numbers, of course. So for a company of Goosehead size, these are very strong numbers, but I'm curious if any of them stand out to you, or you want to react to any of them. You don't have to if you don't want to.
But I don't know what's going into each one of those numbers, so pretty hard for me to react to all of them. But I would say I think we've got really consistent cash flow generation, really strong earnings growth, a massive TAM, and not a super strong competitive set. So I think we're in a really good position.
Thank you for that. Matt?
How can I follow up the Moneyball discussion? So you mentioned competition. The insurance business it's a very fragmented one. So that's a good thing for growth and taking market share, but it also, on the other hand, a fragmented market means you have a lot of competitors. That, it's the definition of it. Is there any other company out there that does what you do in a comparable, franchise business model, or are your main competitors, the captive agents and the, direct sellers?
I would say the main competitors in any given marketplace can vary. Typically, what you'll find is there's probably a smaller regional independent agency that is good in a specific market, but more broadly across the US, you're going to find us competing against the captives probably more than anybody else, just because they are everywhere. From an independent agent standpoint, I don't think there's anybody that has the tools that we have and the ability to deliver for agents and carriers as well as we have. And because we've been able to build up such scale with our carrier partners, it gets us differentiated access inside of their offices, as opposed to what you would get as a small mom and pop insurance agency. So it's tough for me to point to a specific competitor that looks like us, national, personal lines focused, organic growing. I'd flip the question around on you. Do you know of anybody?
I like it.
I don't. Especially not a direct competitor. I don't know if you guys do, but no. So
it ends up being one of the most underrated factors in investing, in my opinion, is how, if you do have a very direct competitor, then it would be nice to know that there are no others. So your Visa and MasterCard, or your Cadence Design Systems and Synopsys. But in so many great investments, it does become hard to name a number two. They do show up in different ways as markets expand. And, there is a number two to Netflix out there, but it's just a great scenario, I think, when we find a company that's very well run financially with a large market opportunity and not a clear, direct competitor, which is why.
What's been helpful for us is we didn't start by looking at what do independent agencies do. We just said, what is the right thing to do? And let's start there. And not being PE or sponsor backed allowed us to take our time and I think do it the correct way. having it basically entirely be funded out of one guy's bank account gave us some degrees of freedom that I don't think other people have had. But it's been a really good business model for us, and I'm very confident in the future runway.
Who
Well,
was
nice
the
you have
one person who funded it?
Mark Jones.
Okay, got it. Okay, good. I didn't know if there was a great uncle. You know, that's great Uncle Joe was unbelievable. He was
No,
really-
I mean,
no, it was
you took
dad.
the leap of faith or being a Bain partner for 16 years and say, well, I'm going to go start an insurance agency because the industry looks pretty broken and the opportunity set looks pretty massive.
Yeah, it also helps have an asset light business model that drives this, a lot, and that definitely helps. And Mark, interesting on the special dividend you all announced, and I think paid. I think paid, announced and paid more than $5 per share. I just want to talk a little bit about that. I know you got asked about this recently on the call, but just to enlighten us a little bit from your seat in the CFO, and then Mark in the CEO chair and the board, and you're thinking about ways to allocate capital, decisions to make with your with your both your balance sheet, then also how to fund that, and just with the cash flow and for shareholders. Can you just walk us through that decision? Why decide to do a dividend versus big buybacks, or just to plow it back into a company that generates pretty healthy returns on capital?
Yeah. So I think we're in a pretty advantageous position because the company funds itself entirely. Uh, really strong operating cash flow. We don't really need the money to run the business. And we've said this a lot of time. You can't just throw money at this and make it run faster. I mean, maybe there's some areas in tech that in theory you could, but you got to figure those out first before you deploy the capital against it. So our philosophy has always been we want to try and maintain an efficient balance sheet. And so 2016 was the first time we did this. We did a levered dividend. We did it again in 2018. We did it again in 2020 and in 2021. It had just been a few years since we've done it. And I think we've been pretty consistent in our messaging that you should expect this type of thing out of Goosehead because we delever so quickly through earnings growth that affords us the optionality for shareholder return. And in 2024, we did do a pretty substantial share repurchase program. We bought $60 million of stock at a pretty attractive valuation. I would expect over the longer term, you see a mix of dividend and share repurchase, just as there's ebbs and flows in the market. But yeah, we want to maintain an efficient balance sheet, but we don't want to get over levered. So we're probably not going to ever be above 4 turns of EBITDA as a total debt number. And given our earnings growth rate, it just delevers really quickly.
Yeah. Matt?
Yeah. So you mentioned earlier that renewal commissions and royalties are a big part of how Goosehead makes its money. And the reason I'm bringing that back up is because one of the things that really stood out to me when I was doing some research on your company is the 84% client retention rate, which stood out to me as high. And one of the reasons that I think it's high is because most insurers don't mention their client retention rate. Is it how does that compare, like in the context of the industry? And what do you do to what's Goosehead's edge in keeping client retention as high as it is?
So I think part of our edge is having a licensed service force. Most places you've got to isolate the different tasks that an agent can do because that not everybody's licensed. Only some people can handle these types of questions. Only some people can handle these types of questions. We've tried to, as much as we can possible, arm everybody with the ability to handle as many things as possible. Naturally, that creates a little bit of complexity, but it's the ideal client experience. They don't need to be handed around. And to the 84 number, that's trended down over the last couple of years, just as insurance premiums have risen so aggressively. And you can imagine if you're a client and you get a 40% increase bill in the mail, you might just say, screw it, I'm leaving this company, I'm going to go somewhere else, not realizing that, oh, I can call in and get a reshop and maybe get a different rate with another carrier. So we've been combating, I think, those premium increases pretty well from a client retention standpoint. I expect that to go back up. Our high of all time was 89%, which I believe is at the top end of what the industry is capable of. I'd like to get us back to that level. That should generate significantly more excess economics, getting back to around 89%.
Okay, so I want to pivot back to when Tom had those Moneyball scores on the screen a few minutes ago. One stood out to me that personally I would have fought back against was the AI score. So you mentioned your technology platform, how it's a big advantage. Where does AI fit into that technology platform? And I see that you spend less on service payroll than your competitors. How much of that is due to incorporating AI, and where do you see kind of AI, growing within your business?
Yeah, I think there's a lot of areas where we can utilize AI to both reduce cost as well as accelerate growth. From a cost perspective, they're a little bit more obvious. How can we automate as many of the tasks that a service agent or a quality control person are doing as possible? So trying to use it almost like a horizontal layer across the entire business, really throughout our entire platform. You could do things like call transcripts and recording to automatically prompt trainings for a service agent to say, hey, this is how you should have handled that situation, as well as automatically learn what is the next best action to take. One of the pieces of our secret sauce with our carriers is that we have 40 million plus agent driven quotes, and the AI tools may be ubiquitous, but the data is not. So we've been able over our history to produce so many quotes that an agent would actually recommend to a client that we could in theory build a policy recommendation engine utilizing AI that produces agent driven behavior as opposed to client driven behavior. I think that's one of the reasons why you haven't necessarily seen a big tech company come into the industry and be able to disrupt distribution, because you have to be able to convince the underwriters that what you're doing is appropriate for the client and is not going to blow up their loss ratios. So because we have all of that data of agent driven behavior, I think that puts us in a leg up across the entire industry. And in theory, can help us maximize profitability for underwriters and minimize costs for clients.
And then just one more for me. So one of the things that I always tell people in investing is if you don't understand what can go wrong with the business, you haven't done enough research yet. So I want to, not to be a Debbie Downer here, but I'm going to ask a little bit about risk. So insurance is inherently a pretty recession resistant business, right? People still pay their homeowners insurance and car insurance, no matter really what's going on in the economy. What do you see as the biggest risk factors to not only just getting your business to the next level, but keeping things, going as they are now?
Yeah, so we're in a really interesting position in the insurance value chain. We're pretty insulated from most of the ebbs and flows, right? When premium rates are rising really aggressively, typically, product availability constricts, you see some slowdown in new business, and your client retention typically takes a little bit of a hit. But having said that, you also get a big raise on your entire book of business. If you get 15 to 20% price increases throughout the entire book, that can make a big difference in offsetting the headwinds from new business production or client retention. The inverse is also true. When pricing slows down, that typically means that carriers are really ready to grow in a lot of different markets. And then our agents are able to really rapidly onboard a lot of new clients. And then on the flip side of that, profitability must be high for carriers if they're not taking a bunch of rate, which means contingent commissions, which are 100% earnings, get a lot bigger in years where there's not super high price increases year over year. So we've very intentionally placed ourselves in the value chain where I think you're closest to the client and can maximize profit pools. It is a super regulated industry. It is 50 different departments of insurance, which I think helps us. A, it's a competitive moat, but B, it also means one regulator isn't going to screw up the entire business. We've been able to navigate every industry from Texas to California to New York. They all have their own complexities and idiosyncrasies, but it also means we're used to change as well. So those legislatures turn over frequently, and we've got to adapt to all of those things. That is always going to be a risk, legislative risk. I think the biggest risk is just being able to onboard, train up, recruit new producers across the industry while we continue to invest in AI tools. That's probably the biggest area that keeps me up at night, is how do we get the right talent in the door in the right geographies and get them the right product access?
Mark, can't really talk about insurance without talking about all the devastation that we saw in California just from the recent fires, but just climate change in general, as we know, just impacting just different insurance markets. But what are you seeing from the California market, the opportunities there, the risks? Just what are you hearing from different franchisees as they think about those kinds of situations?
Our franchisees on the ground in California, I think, have done a phenomenal job taking care of their clients. We have had people that had their homes burned down in California, and it's devastating. And I also think it highlights the importance of having an agent that understands the complexities of the product that they're writing. And from our perspective, because we have such a history in Florida and Texas, we're very used to natural disasters. We're used to hurricanes that cause moratoriums, that cause spikes in claims activity, but also taking care of clients when they're in their most need, right? They don't need us most of the time, but when they do, we need to be able to be there for them. So we have a long history of doing that, from Hurricane Harvey to all the hurricanes that hit Florida this year, and all the hurricanes really that have hit the entire Gulf Coast in our company's entire history. So we were prepared to handle what was going on in California. What you're seeing now is some moratoriums, carriers not necessarily writing in the southern half of California, but it is a big state. It's got a lot of population. It'll be interesting to see if there's any regulatory changes associated to that to try and allow underwriters to price risk a little bit differently and make it a little bit more enticing for the admitted market, but remains to be seen. But absent that, we still have a very robust product offering in California, and our goal is always make sure the client is as taken care of as possible. It really makes me sad when I see the amount of economic losses compared to the amount of insured losses.
Sure.
That tells me that other agents out there are not doing a good enough job explaining the nuance of the product.
And you talked about this, I think, on your recent call. It's about twice as high, right? Like just that gap between what's insured and what's not is extensive.
Yep.
Which is all opportunity for you all.
Yep.
Tom.
I first recommended Goosehead, I believe in April of 2021, around $40 a share. Unfortunately, in October of last year at about 110, I trimmed a little of the position because it had gotten to a larger amount of the overall portfolio than I wanted for our members. And of course, the stock has gone from 110 to 120. So we've missed, but we trimmed a little. So we're cheering for that to happen. No deep regrets there. But since we have the CFO, I'd love to hear for someone looking out the next 5 to 10 years and sort of a shortcut view. What do you think are the 2 or 3 things that someone could follow to get a good sense of whether the CFO thinks things are progressing very well for long-term shareholders?
Yeah, I would say continue to tune into our earnings calls and pay attention to our earnings releases. And some of the metrics to watch there would be how the producer count grows, how the policy in force growth rate trends. So, the second quarter of this year was 11% policy in force growth rate. The third quarter was 12%. The fourth quarter was 13%. So consistent accelerating growth rates. And then as we've talked about, client retention is really one of the most important metrics for this organization. It's what drives more than 50% of the revenue and probably closer to 100% of the profitability. So we've been trying to signal to the market that you should expect kind of gradual improvement in that number over the next year as the product market kind of heals and pricing slows down over time. But I would say you track that number very closely and then just watch us continue to grow the top line and expand the bottom line.
Thank you. I'm curious, as CFO of a public company, how much does it matter to you who is in your institutional shareholder base? For a company of your size, what is the value of having, actively managed institutional shareholders versus the passive index funds that now own, 10% or more of every public company? Does that matter to you? Obviously, it probably takes some time, so it probably gives you some useful insights. But do you watch the flow and change of your institutional owners?
Yeah, we definitely do. And we understand what each one of our institutional owners is really looking for in the business. And we're not going to be able to meet the needs of everybody all the time, but that shareholder feedback is really important to us. And they can provide valuable insights. I mean, they're aligned with us. They want the business to grow and margins to expand. So to the extent they can be helpful in making introductions to potential partnerships or kicking around ideas on strategy, I certainly think that's helpful. But we have going for us as well as 35% of the stock is still owned by one guy. That's pretty helpful.
Now some wildcard questions as we move to the close. How are you like your mother and how are you like your father?
That's a good question. Well, physically, I look more like my mother, right? She's got red hair and freckles, so similar facial disposition, but I'm about the same size as my dad, 6'4".
God.
How about
I probably
work style or professional approach?
Yeah, I would say I probably, since my dad transitioned to executive chairman of the CEO role, I've seen him take a couple of days off since then. But in the previous, 30 years of history, I'm not sure I saw him take a full day off. So that's kind of been my example for my entire life. That feeds into me as well. I don't really think about work-life balance. It's more like work-life integration. It's everything that I do is either really about my job or my family. I don't really have a ton of hobbies. I got 3 kids under the age of 4. They take up all my time, and when I'm not doing that, I'm here doing this. And that probably leans into more of my mom's spirit. So 6 kids, doing a lot of it by herself, as my dad was a Bain partner traveling around. So a lot of time with the kids.
Tell us a little bit about Mark Miller as the CEO, and what's even 1 or 2 things that might be a little bit different in his approach.
So Mark is excellent on operational excellence. So that's a different level of kind of scrutiny and managing to the details than what we've had, I think, in the CEO position before. My dad is a very big strategic thinker, broad strategy guy. Mark is also very strategic, but really on the details and operational excellence. That's been a really nice thing for the organization. Knows how to manage people and metrics very, very well.
Is there something that stands out at Goosehead that makes it truly unique as a corporate culture? Something you do once a year, or some unique way that you think about compensation for your full timers, or what is distinct for you about Goosehead as a company?
Oh, we're a really young workforce. And we get most of our talent right off college campuses, and that naturally leads to a really youthful energy across the organization. There's a lot of groups around. There's Bible studies, there's basketball groups. We try to really foster that kind of community type relationship. I think it's a very fun working environment. We got a chili cook off that we do every year. I'm not sure that that's super differentiated in the industry, but I really truly care about what our employees think and how they feel about the business, make sure they're feeling engaged with and that we're meeting their needs as well.
At our company, we call all of our employees fools. At your company, do you call all of your employees geese?
We don't. No, nobody's a goose. So there's only one goose. That's Lucy.
And this is my final one, and maybe Andy or Matt has one they'd like to close up with. But this is a selfish question that I have to ask. I'll name a single example where it was such a beautiful question. We often ask, what companies in your category do you admire, or companies in the world, because we're always looking for great investment ideas. And we're not asking you to suggest it as an investment, just what businesses are admirable to you. I remember talking to the executives at a company called Wix, and I asked them, what company do you admire? And they said, ServiceNow. It may look richly priced, but that business is just set up for major success. And I did another deep dive into ServiceNow and started recommending it after that. So I'm not putting any pressure on you about it, but what companies do you admire, either in the insurance industry or outside?
I'd say certainly inside the insurance industry, Progressive. I think they're the leader on thinking about how to go at this business, especially from an underwriter's perspective. They do a great job on their technology. They manage their P&L very, very well. We have a lot of respect for Progressive.
That's great. Matt, Andy, anything you'd like to ask in closing?
Just a very quick one, Mark. You had mentioned about talking to younger consumers about insurance. Just curious, what are some of the techniques that you talk to young people about insurance? We try to talk to young people about investing in finance and getting them started. But I'm just curious, have you found any secret sauce about trying to teach and instruct and show why insurance is so important for all consumers?
Well, it's a product that if you live somewhere or drive something, you have to buy. So there's not really any escaping it. So we've got to be able to explain it appropriately to all different kinds of audiences. And because our workforce does skew a little bit younger than the average, I think our average age of an agent is like 26 or 27. That allows us to communicate pretty well with those college age kids needing auto insurance or buying their first home. We don't really have that roadblock, and it's not the industry average 55-year-old trying to talk down to a 26-year-old. It's really peer to peer.
Matt, anything in quick follow-ups?
Not really, other than to follow up on Andy's. Like it seems like educating the consumer is one of your biggest challenges, and you sound like you're embracing it. I mean, I know I used to be a college professor. The younger generations today really don't they like to do things online and don't like to talk to agents, like you said earlier. So how do you said that your agents are effective at communicating with the younger generations, but how do they get them to not just apply for, because you mentioned Progressive by name, how do you get them to not apply for homeowners insurance directly through Progressive and go to a Goosehead agent?
Yeah, so typically how that's happening is the loan officer is saying, you don't have insurance? Great. Here's the person you should talk to. I trust them. They're going to give you a good service. And usually when you're buying a home, you're making a lot of really complex financial decisions. You want to talk to an expert that can help you. Now, if we were specifically just targeting auto or renters, which is just not really a super profitable line of business for us, it would be a different story. That's where I think you can go more of the direct to consumer type route and try and onboard clients without the cost of an agent. But where it's really important is in homeowners and understanding the complexities there. And that's what our agents are really focused on.
Mark Jones, the Chief Financial Officer of Goosehead Insurance. Mark, thanks so much for joining us here at the Motley Fool today.
Absolutely. Thanks for having me.
Thank you, Mark.
All right, fools, welcome to another hour of Fool24. I'm Tim Beyers, with me Brian Orelli. Brian, how you feeling today? We got earnings.
Good, yeah. Not too. The earnings for biotechs are slowing down at this point. We're at the companies